You are live.
Okay, welcome to May 1st Trade Alert. Sell in May and go away. Will that be the popular saying? I'm predicting that we're getting near the tipping point and that the geopolitical tensions are going to become the focus leading into the election. So I do want to start off by acknowledging that we do have drawdown in our portfolio. So we went from up 15% in 2020 to down 4.8 in our pro strategy with the boot camp, and down 6% if you don't have those boot camp trades. What I do want to point out though is that just about all of that drawdown is currently held in a set of put options. We're going to talk about the value of these put options and why I think you could put these on today. And for everybody who still has that position, I still highly confident in this set of put options can give you the return we're aiming for in 2020 with nothing else. So we'll go through everything from head to toe, look at the duration, but do keep in mind over half of that investment into your put options give you protection into 2021 and then all the way into 2022. So if you think of it more like a life insurance policy that you've paid for 2 years out the gate, and then take that drawdown and divide it out over 24 months, then clearly it's not nearly as negative as one would be led to believe. So let's take a look at the big picture, and then we're going to jump into the trade alert. If you're an existing member, you have no changes today. You have the full portfolio already built, and my expectation is the big leg down begins in May and lasts for no less than 6 months. Okay, it's going to be a very heated election cycle, and things are getting tense to say the least. I've got a lot of content to show you. I also want to point out that in the webinar document that sends you a teaser each morning, I'm now including articles referenced in today's webinar. So you can go in and deep dive into all the content and research that is provided on a daily basis moving forward. So this is just a handful of the articles we went through in the last 24 hours and does not include the YouTube videos. Okay, so that's a look at what we're going to cover today in terms of the scope of top news related to what's happening under the surface. So everybody wants to know what on earth made the stock market go up as unemployment has hit depressionary levels, and I'm going to show you. So here's what's been going against us and why that's going to stop going against us in the coming weeks. What we have up on the screen is the H41 release, which is put out every Thursday at the market close from the Federal Reserve. And what it does is gives you a summary of what they've bought and sold, as well as creation of new monetary credit. So when the stock market crash began, they started off buying a little bit of treasuries, and you can see on the week of March 5th, they added $25 billion to their balance sheet. The next week, March 12th, they went up to $77 billion. Then all hell began to break loose. March 19th, week over week, they added $240 billion to their balance sheet. March 26th, they went in with the bazooka, $506 billion. Okay, and they're primarily purchasing treasury bills, uh, treasury bonds and notes, mortgage-backed securities, and then they began lending money to other central banks who were desperate for dollars and had begun selling their treasuries and equities positions to keep their banking system operating. The April 2nd was the biggest print, a $600 billion addition to the Fed's balance sheet. That's over $500 billion in a single week added to the money supply. But after that, it's been a steady course back to no quantitative easing. So on the week of April the 8th, they dropped it to $393 billion. On the week of April 16, $228 billion. On the week of April 23rd, they've dropped it to $255 billion, which was interesting because I was actually expecting that to be a drop as we did increase by 30 billion week over week the prior week. And now on Fridays, they do give us their intentions for purchases for the following week. So last Friday, they told us they were going to dramatically drop the QE. And so sure enough, they did. This print this week was only $146 billion. Now we'll look at why they need to stop doing this if the government's going to fund the massive stimulus plan that they have passed, which is $2.6 trillion, and they're just getting started. So we'll look at that, the big economics here, and why we've been just holding on strong to our positioning without flinching, not for a second. And we'll also look at the hedges we have to protect us against further upside risk. But the big picture is the QE is winding down, and that is exactly what we need for our portfolio. To summarize, quantitative easing is a inflationary pressure. So when they do big pushes in QE, you're going to see stocks and gold fly higher, and it does apply pressure to the bond market. In this case, they've been aggressively flatlining the bond market, building support. And when they do rate cuts without quantitative easing, that's extremely bullish for bonds and not bullish for stocks. And so our basic prediction here is that companies are going to have less profits and revenue in 2020 and 2021 relative to 2019. And at the same time, the US government's debt is going to grow at an accelerating pace. So when you put those two together, you want to be long bonds, especially US 30-year treasuries, and you want to be short stocks. All of this noise in between that we've experienced in April was a very quick fix, more like a steroid shot, not a cure, to try to stabilize markets. What comes next, I believe, will be the most dramatic and vicious stock market crash in history, followed by the biggest ramp up in US Treasury bond prices that we've seen in history. Okay, and we'll show you the analysis behind this. First of all, though, I do want to point out a few top pieces of news that are very important for our strategy. Okay, so first of all, what's coming down in the political sphere? Well, we've been watching them tiptoe towards these headlines and have many positions that can generate very significant returns if any of this begins to become true. So we have the yuan crashing after Trump weighs blocking retirement fund access to Chinese stocks as the war of worlds escalates. So we've had all of the top officials from the US slowly but surely put this blame on the current crisis on China and saying that they could have warned the WHO as well as the rest of the world way back in December, but rather they told everyone that this does not spread human to human and began hoarding supplies. So I think this will be the tune heading into the election, and that it's going to get more and more aggressive as the weeks come by. So that's one headline I did want to pull up. Trump speculates that China released the virus in a lab, potentially by mistake. Okay, so we're slowly but surely seeing these important headlines. And then another headline I do want to bring up before we go into all of the news is this set of articles. So the big question is, or the big debate right now, there's really 3 points of view as to what we've done with the lockdown on our economy. So to summarize, there's a group of people who think this is a highly deadly pathogen and the lockdown was well deserved and quite frankly should remain locked down. There's another group of people who think it's potentially been a plandemic is the popular phrase for it, that this could potentially be dangerous or not, but that this was planned and that the lockdowns are being placed on society to be able to get the government to pass stimulus bills that benefit their donors and pass new laws to increase the size and power of the government. And then you have another group of people who think that this is not as bad as the flu, that the lockdowns were completely unnecessary, and that we essentially pulled the fire alarm after the house had already burned down, that everybody's already had this, and that this is nothing worse than the flu. So where do we fit in that bucket? And will there be future lockdowns? This is critical for predicting when the economy can get back to normal and how long we're going to have corporations having bad earnings, bad revenue growth, and the government's going to have to continue growing its deficit. So, a popular critique of the mortalities coming through is that the doctors are being incentivized to essentially say that every single mortality is due to the CV. Okay, so that's a uh, popular critique. And the truth is, the hospitals are incentivized to do that because they can get a lot of money from the government if that is the case for each mortality. So the other big topic is how many people have already had it. So we've got a lot of little antibody tests happening across the country that are coming in with figures that are around 6.7% average antibodies. Now, the problem is the way that these tests are designed are in a very small sample size. And by the nature of how they're sampling, it's potentially bringing in people who think they have had the virus. So I'm not surprised that those figures are coming in quite high at a antibody rate around 6.7 is the current average over about 10 significant tests that we have at our fingertips. But again, they're all small sample sizes. So, so what's the truth? Is this a big deal? Will there be future lockdowns? And is the government going to have to keep printing money it doesn't have to try to save the economy? That's really critical for predicting the timeline and length of this recession or potentially Great Depression we're heading into. And then furthermore, what will the government be able to do to retaliate against China if indeed we believe that's coming in the near future? So let's try to dissect that and go through a few pieces of evidence that can hopefully bring some light. So this is straight from the CDC, and this is looking at the number of deaths on average in the orange line. And then we can see this huge spike that's way out of the average right as the pandemic broke out. Okay, so this is really the key data that's quite hard to ignore if you want to believe that this is not a dangerous pathogen. Okay, so I have another set of data. This is based on 24 participating countries in Austria, Belgium, Denmark, Estonia, Finland, France, Germany, Greece, Hungary, Ireland, Italy, Netherlands, Norway. Okay, you get the point. UK is included in there as well. And so you can see there's this a clear spike right around the end of each year with the flu season, but all of a sudden, out of nowhere, we have this out of the on the when the curve is normally sloping down and mortalities are dropping, we have this huge spike. Okay, so I think without question, uh, between these two reports, which are quite alarming, especially if you're over 65 years old, that this is indeed highly dangerous and that the lockdowns were warranted. Okay, so that's important data to have at our fingertips. Now, the next thing we want to do is try to model how far along are we in terms of this pathogen working its way through society to the point that it's not going to be a drag on our economy or going to be able to get back into a normal routine, get business back to normal. And so I've been using this model and updating it daily with the best data I have and trying to undershoot it so that this could potentially tell us we're further along as soon as possible. So in these two models, we have a base world population at 7.5 billion. I'm assuming that 50% are at risk of infection. Now, I do have to say that the data I have would suggest this is upwards of 70 to 90% are at risk and don't have any natural immunity. But let's just put it down at 50% because if we did get to 50%, that would be where society has reached near herd immunity. And that's when I'd want to flip from being long bonds to long stocks, or if we were to get a vaccine. Now, there's a lot of information coming out about the administration trying to rush a vaccine with hundreds of millions of these as soon as this winter. So we'll take a look at that information as well. Operation Warp Speed is the nickname of this supposed project. So if we get 50% of the population to be infected, which is what we need for herd immunity to get this back to a normal economy, and that only 1 out of 10 will actually show sickness. So we're going to assume 90% of everyone who does catch this will think it's a minor cold and will not seek medical attention, uh, and or may not even know they've ever had it. So with children, we're finding that this is the case. With healthy individuals, for the most part, we're finding this to be the case. And as you go up the age range or have high blood pressure or poor cardiovascular system, we're finding that those are really the ones who are ending up in a bad situation. So we're going to say 9 out of 10 people are not a problem. Only 1 out of 10 will even think that they're sick in the first place. Now that could be a low ball estimate, but for now, that's my best estimate. So of the 10% of the 375 million who will get sick and feel symptoms, this does bring us down to a new figure as to how many people will actually need hospitalization. So of the 375 million who get sick, we're going to estimate now that 20%, this is straight from the CDC, that 2 out of 10 will need hospitalization. Okay, so that brings us to 75 million people around the globe who are going to need hospitalization. Now, we know that many countries cannot afford this and will not provide that, but we're just looking at the big numbers at this point. Okay, so for those of you who do end up losing oxygen, that's really the key thing that's happening. The oxygen levels are dropping extremely low. Once that happens, there's a very low success rate in saving people. In fact, we're seeing 80% or more who end up in the ICU room not surviving at this point in time. Now, perhaps that's because we've been using ventilators and this is actually attacking the blood cells and the arteries. But regardless, right now, this is still a low ball figure. And the real figure is that less than 1 out of 10 is surviving hospitalization in the ICU room. So this is rather bleak, but this does put my estimate that we would not reach herd immunity with no less than 60 million deaths. So if we put that into our modeling, and we currently have 230,000 mortalities around the globe, at least that have been reported, this brings us to a very low figure of only 0.4% of the spread of this pathogen has been achieved. Now we know that the mortalities are a lagging indicator. There's a lot of people already sick that are going to be coming through the pipeline. So I use an error of 10 times. So if I was off on all of these estimations by a factor of 10, then we would still only be sitting at a 3.8% completion rate. So you put this into perspective and you think that the world can really reopen and go back to anything like 2019, you realize that we have a very rough road ahead, and that if there's not strict controls, if everyone's not wearing a mask, that the mortality rate is going to begin skyrocketing right back up. So if you study the Spanish flu, 1917, 1918, they did just this. They got it under control, had very minimal deaths, and then people were freaking out, feeling like they were losing their civil liberties, that it was just a big hoax. And within 6 months, we got the big wave. So is this going to be similar? Well, I'm afraid it very well could be with what is happening right now with states reopening and not everyone wearing a mask. Poorer countries are doing very little to treat this whatsoever and really just letting it rage through their societies. And specifically, countries like Brazil are in this basket. Okay, so that's not very good news in terms of hoping that we're anywhere near a herd immunity. We'll talk about vaccines a little later, but what about in the United States? Currently at 63,750 mortalities. Well, the same metrics, and it gives us a range of 2.2% and as high as 22%. So the highest reading of antibodies that has happened in any report was right in the dead center of New York City. And a very small part of New York was coming in at a 20% antibody rate. So I do think in the US it will be much closer to 2% completion versus 20, as we're not seeing the high level of mortalities in many, many states. Really, it's been laser focused in New Jersey and New York. So based on this modeling, I would argue that this is a very dangerous pathogen, that the lockdowns clearly did work, and that if we reverse the course of the lockdowns, that we're going to see exponential growth very soon, and that this will cause another set of lockdowns in hotspots. Okay, so that's very critical to predicting how long the current crisis is going to last and what's coming up next. Okay, so let's go back to our trade alert, and I can come back to a lot more supporting evidence soon. But really, the key highlights are that we are seeing the government officials start to place the blame on China. We are seeing the Fed start to reduce its balance sheet growth, known as quantitative easing, which is really what's given us some drawdown in the month of April. And we can see with enough proof that this is not a hoax and that there quite likely will be future restrictions in commerce and in the mobility of society. So we put that all together, it's very negative for stocks and very bullish for bonds. Okay, so last year the bond market had to sell a $1.3 trillion deficit. That's the money we couldn't raise from taxes. That was the same plan this year, but now that deficit is estimated to become closer to $3 trillion. And that estimate is from Goldman Sachs, and that this will grow again next year. And in general, the mechanism that allows the government to create a growth of its deficit involves yields on the Treasury getting crushed. Okay, so they have a mechanism that we can review on how that works. But without failure, every time there's an economic crisis, the Fed does the same thing. They cut interest rates, which incentivizes the purchases of treasuries by large banks. Shortly after, you have a stock market crash that tends to last a year to 2 years. And at the very end of the crisis, after the losses have been absorbed, the underlying problem has been solved, then they come in with a big quantity of quantitative easing for years to come, which allows these banks to sell their treasuries to the Fed for a massive profit and turn around and invest back into stocks. So we've seen this happen about every 10 years for the last century, and I really don't think this time will be any different. What's different this time is that the crisis is no less than 10 times worse than the 2008 crisis. In fact, I would argue potentially 100 times worse in every aspect. And indeed, it is a worldwide problem. So when we put that into perspective and realize they had to do QE for a short stunt just to give us time to figure out how to deal with this, get the legislation passed to fund the government to try to plug up all the holes in the ship, well, we can understand why they did come in with that massive amount of QE, why it's given us some drawdown in our bearish strategy, and why we don't want to change our positioning. Okay, so let's dive into today's trade alert and go through each aspect of our portfolio. Okay, so we have 3 products. Okay, we have 3 products depending on how much capital you have to follow. If you have between $30,000 and $75,000, you're going to be most interested in following our basic strategy, which only trades US equity products. So you have a 3-part strategy to enter in today. You have a bullish hedge, which is the QQQ call option, expiring 6/30, with the profit target to sell that call option when the QQQ hits 230. Okay, so we were looking at Amazon as a bullish catalyst yesterday. That came in with quite disappointing data. Apple came in with some pretty concerning forward guidance, which was that they had no forward guidance. So the market is getting shooken up most recently. But again, this is our hedge to really protect us against quantitative easing, pushing the markets higher. So this is a 1% position, and it provides us a hedge against a larger strategy if there's further upside risk. And again, the big risk is the amount of quantitative easing the Fed puts into its balance sheet. This does drive asset prices higher. But as we can see, the trend has been that this is crashing at rapid pace from 600 billion to 400 billion to 200 billion to 250 billion down to 146 billion. Now, near the close of the market today, we will get the new announcement from the Fed. I'm expecting they will continue to reduce the quantitative easing. The next trade we have is one in which does well if the market just trades sideways. If we go up slightly, that's fine. If we bobble up and down, that's quite fine. This is a volatility play, and I call this the quiet before the storm. I do think we're going to see the market consolidate and just bounce around until really a handful of factors drive the market lower. Okay, so these are VIX put options, VXX, and there are 3 positions which represent about 3% of your total assets at this point in time. So if the market just trades flat and bounces around in this 280 to 300 S&P range, over time, the volatility index will draw down and these put options can go up in value. So these are 3 hedges, again, against our larger strategy that you can place today to help provide cushion while we wait for the bigger move down. Now, this is the most exciting position to build today, which I had on hold for the last week or so. And this is a set of put options that, again, only cost about 3% today. When our initial members put this on, it was substantially more. And it was right before the Fed surprised us with $2.5 trillion of QE. So we're still long these positions, and my intentions are to increase the risk in our SPY put options quite likely next Friday. So if you don't have this set of put options, we're endorsing to get into it today and expect to grow this position next Friday, assuming that the Fed does do what I expect and announce an even smaller amount of quantitative easing from this week into next week. Now, catalysts for our SPY put options: number 1, conflict with China; number 2, for the next 6 months, economic data and corporate profits and future guidance are going to be extremely negative. So that's really the key things coming into the portfolio. And at the same time, the Fed's winding down quantitative easing. Also, the entire world's in this same predicament. So I think the time is getting very close for the next leg down, and I do believe it will begin at some point in May. So right now is a great time to put these positions on, and do expect us to grow this position potentially next Friday. Now, if you have only 30,000 to follow, I do have notes for what I would do, and that's to just take these top 3 trades and ignore these 2-year leaps, which give you protection into 2022. So what are the target returns we're aiming for on each trade? This can deliver several 100% if we do go substantially higher. Now, with the miss on Amazon, I think really what would get us there would be some big central banks that are now doing QE, such as the ECB, Bank of Japan, really the last hopes to give us another dramatic push higher. So it's a 1% position. And again, it does act as a hedge against our larger strategy, which we're going to be building into this week and next. If we trade flat, these can do extremely well, and the potential return on each position is anywhere from 50 to 250%. Now, if the volatility does go higher, obviously these could lose 100% of their put option value. Okay, so these are a hedge against the market just trading flat and the relative cost of options going lower because the volatility index goes lower. So that protects your time premium in these put options that we're going to endorse. Now, the target return on these are in the 500 to 5,000% range. These are very leveraged, out of the money put options. And next Friday, expect me to potentially buy a July expiration and probably a much more expensive put in the 250 to 270 strike range. And that'll really be the last touch we need for what we believe is coming down the pipeline for basic members. So what's the plan? Once we do get to a bottom, or at least a short-term bottom, our intentions are to rotate the basic members into a group of ETFs that will be benefiting from the stimulus of the government and a change in consumer behavior. So I'll get to those at the bottom, but in general, it's e-commerce as well as healthcare, biotech, medical device related companies. And again, once we realize that there are potentially tens of millions of people who will be sick and need treatment, this is going to drive a lot of profit and growth into that sector of the economy, where many sectors will be really in a lot of pain. So I do like the set of ETFs we have prepared to buy, much better than just the general S&P 500. When we realize that there's going to be a major transfer of wealth, some companies are going to thrive, many will go into bankruptcy. And because of the small business loans, it's made it a delay in terms of figuring out who's going to survive and who's going to fail. So look for many, many bankruptcies in the coming 6 months to also provide support for our trading strategy. Namely, a lot of retail shops, especially that were thriving in mall uh, commercial properties, are in a lot of trouble right now, and many are starting to file bankruptcy already. Okay, so that's your basic strategy. Today you have approximately 7% of your portfolio to put to work, and then you sit back and wait. Now, this is something I like to compare to building a house for an analogy. And the option trades you have here are really the foundation of the house. The walls will be the equities we buy once we believe we're near a bottom. Okay, so that's part of the house. In the basic program, we're only trading US equities. You're really missing a good portion of where you should have at least half of your capital. So in general, our pro members are using 40% of their total capital to play US equities, but they're putting the rest of their capital to work in the bond market and the commodities market. So once we go down to our pro strategy, keep in mind you would still build every position that the basic member has, but you would also add on our pro positions. So what's in the pro strategy? We're loaded up primarily on that 30-year treasury, which is held in the TLT ETF. It's by far our biggest position, highest convicted trade, and also most leveraged trade with this set of call options. Now, next Friday, I do also intend to move these strikes from the 160 to 170 range. And remember, when we initially put these on, we were way below those strikes. So you can put those on today. I do believe they have a high probability of generating a return, but expect this Friday to readjust these positions and move our strikes substantially higher. Originally, I was thinking we'd get resistance on the TLT at the 180 level, but now I'm thinking that we're going to blow past that and find resistance at a much higher level, which we'll cover likely on our pro exclusive webinar next Thursday. So the TLT Treasury really acts as the roof to your house. It's critical. It's our largest position, and it's the easiest to predict what will happen. Not only do we have the Fed actively protecting this market as the single greatest asset of the US, which is the dollar combined with our great mountain of debt, But the key to predicting whether the TLT goes up or not is really one in which we predict if our deficit will grow. And we're not just talking about going from 1.1 trillion deficit last year to 1.2 trillion this year, or a flat 1.1 trillion a year. That actually would be bearish for the bond market. What's bullish for the bond market is when you go from $1.1 trillion deficit and skyrocket to 2 to 3 trillion this year, and probably 3 to 4 trillion next year. The only way they pay this off is to drive yields lower so that the holders of these debt generate a profit from the bond appreciating and not from the lousy yield. So this is really where I think you'll see the best return with the least volatility for the next 24 months is in this TLT position. And so we'll look at some charts, but with the QE that was provided in April and the massive rebound on the S&P 500, in a healthy world with real growth in corporate earnings, the TLT would have been smashed. We should have been sitting on massive losses in the TLT. Instead, it has traded up and been bouncing around in that 167 to 170 level. To me, that's showing extreme strength, and I'm more confident in this position than ever before, watching it remain so strong in the face of such a huge move up in the S&P 500. So this is your bond position. And again, it ties into the rest of the portfolio. In general, stocks go down, bonds go up. So to see the bond market go up with stocks really is a giveaway that this was just a central bank pump and not true growth of earnings and any reasonable reason to be buying equities at these levels. So we're hedged in case this continues to go up with the VIX puts and the QQQ call. But the big picture is we're going to derive the majority of our profits this year from these out of the money put options, as well as our very large bond position. And I do anticipate both the TLT going up as the SPY goes down. So it's a double punch and gives us two ways to attack that market. Now, in general, I'd expect the TLT to slowly go up over time and the SPY to viciously sell off in only a handful of trading days. So the TLT is something we can really enjoy and profit from as long as the government's growing its deficit at an accelerating pace. But the opportunity to short the S&P 500 is going to come and go. And I believe the majority of losses will be realized in a handful of trading days. If you go back to 2008, you can note that almost all of the losses in the S&P 500, despite it lasting a year, were hit in 5 trading days. So this is not one you can sit around on and be able to catch these big moves. You really have to be positioned and then catch the move when it comes. Okay, so what other positions do we have? Well, we have 2 other hedges that help protect us and also give us a leg up in terms of what I see coming next. So we have a gold miner position and we have a USO. So I do expect the government to bail out United States oil industry, which is why we have the USO position. We'll talk about what exactly USO is in this presentation. It's not United States oil companies, it's really several futures contracts. So we'll look at what that means for our strategy. But I do see the government fixing this problem sooner than later. This will be a quick hit to sell and take a profit. Now, gold miners is a bullish bet on quantitative easing. So we've seen some pretty substantial gains in GDX, and I do want to lock in those profits next Friday with an in-the-money put, expecting quantitative easing to come to an end. So GDX, I want to get to a year hold time before the rest of the crowd so we can have a lower tax obligation when we do start taking profits. And then I want to be able to rotate into silver before the rest of the crowd. So I, in general, believe we have a deflationary force coming and that you want to be long bonds and short stocks and that gold will have a significant pullback. Now, we're not just long these ETFs. In our program, we constantly have put options protecting our largest positions. So note that we do have this put option on the TLT, which protects risk on our treasuries. Now, if I'm so confident in the treasury market, why would I need a put? Well, let me tell you what could happen. What we have not seen yet is the government actually sell this $2.6 trillion deficit into the treasury market. So the first week of each month, they tend to sell that 30-year treasury, which currently has assets under management of approximately $800 billion. Now, their intentions are to finance this debt at the lowest interest rate possible at the longest duration possible. So far, all we've done is issue short-term T-bills, which until this week were being bought by the Fed itself. So we were actually just devaluing the dollar and not actually selling any credit to foreigners. Now this week, very good for our strategy is that we are seeing the foreigners fight, not just buy, but fight and drive yields lower on the T-bills. So what happens next is they're going to start slowly rolling the short-term debt into the longer duration debt, and the growth of the 30-year treasury assets under management is really the key for our positioning. Now, normally what would happen if you expand your line of credit as your income has greatly been reduced? Well, yield should spike, right? That's the natural reaction. If you're less credit worthy and you want to borrow more money, it should come at a higher interest rate. But what happens when that interest rate gets too attractive? Well, everybody rushes to buy those treasuries, and that in itself causes the stock market to pull back. So there is a risk that as they do start to dramatically grow the size of the treasury, that there could be a short-term pullback in the TLT that spikes yields and then gives us the effect we're looking for. But many people know this and want to front run into that bond position. So there is a risk of a short-term yield spike as they do grow the size of the 30-year treasury auctions. But so far, we're not seeing that. And as they ramp up the size of the T-bill issuance, yields are dropping and foreigners are now fighting over these. So that's why we have the put despite the high conviction in that trade. If we see all the central banks around the world do a lot of QE, more than expected, this bullish move in equities and gold could go longer than expected. So I do like having the GDX as a further hedge. And also we're constantly buying these puts to protect us against any downside risk in this position. So expect to see a new GDX put Friday. Currently, GDX is protected by the 28 strike 821 2020 put, which is currently $5 below the current trading price. And so we've been buying these put options, paying them off on GDX, and seeing some pretty substantial returns in that. So expect to lock in those gains most likely next Friday. And then look for the next big leg down to sell those puts and remain long our gold miner shares. Okay, the oil problem could crash the stock market in itself. It's a relatively easy fix for the government and one of the few bullish events I see in the short term. So the strategy for them to fix this would be to loan money to the oil companies, incentivize them to reduce production, and then to create infrastructure to hold several hundred million barrels of oil. You put that into place in the next couple of weeks, USO is going to pop, and we're going to sell those shares and still remain long our protective put, as I do think the general situation for oil is getting worse and worse, and that, again, we're not going to be able to go to a full economy anytime soon. So for oil prices to rise, we need a lot of bankruptcies and a lot of reduction in production. Now, the put option we're currently using to protect USO, because USO could go to zero. So I don't want people to think that's a no risk trade. If all the future contracts for the next 4 months went negative, USO could go bankrupt. So because we have the put option expiring January 15, and that is a typo. Let me fix that. My apologies. That's 2021. We have protection on this position to January 15th of next year. So if we did nothing else but hold the put to expiration, we would walk away with $20 per put, which is again more than the trading price at 1860 today, and we lose the cost of our put option. So your maximum loss in this position is realized when you place the trade. Our plan is to wait for the government to bail out United States oil companies, create new storage capacity, which I believe could spike USO to a target of between $40 to $60. That's where I'll be willing to sell those shares. And then again, remain long our put option, as I do think we can see another big leg down in Brent oil, which could put pressure on WTI, which is the main product in USO. Okay, the next position for pro members is the FXI put option. This gives you exposure to large cap companies in China, excluding Alibaba, but including Tencent. There's a lot of bogus construction insurance companies in there and banks that have huge losses, primarily in their real estate books. They overdeveloped dramatically over the last 2 decades. Half of their cities are unoccupied and just abandoned. They have tens of millions of condos that are not completed, and their real estate market is really a house of cards ready to be collapsed. Your average Chinese male who's considered marriable has 3 to 5 houses now. They don't rent any of them, and they don't even complete building these out. So it's a huge Ponzi scheme in the real estate market. What we want to see for FXI is either a general stock market crash and or actually the US restricting capital flows to China, which again, we just saw headlines that they are considering that. If they were to actually delist FXI, what would happen? Well, you're going to pay under $1 for that put, but you're going to get the full value of that strike. So this trade could return something around 30 to 1. So a 1% position in this FXI put could potentially give you a 30% total return with that single trade. So I really like that positioning with FXI, considering the geopolitical tensions that are quickly rising. Now, in the basic strategy, depending on where you entered, you're going to have between 5 to 10%, 15% of your total portfolio at work, with the rest of it sitting in cash. And again, we're expecting big profits coming out of healthcare, biotech, medical device, e-commerce, and then we have a value play. Boeing continues to have worse and worse news, but the military budget grows like clockwork, and with the threat of China rising, I anticipate this to continue to rise for the next several decades. So I do like getting ITA as a ETF as our value play. The rest are going to be growth plays, that these companies will have better growth of profits relative to their peers. And again, that's after the entire market's been repriced. Now my timeline has changed. So I was thinking that we we're going to do a more extreme lockdown for a longer period of time, get better testing ready, more masks created. But it appears that there's too much political pressure, too many protests at the core voting base for the current president. So it does look like that pressure has forced him to remove these restrictions and put the task on the governors, and which we're seeing a lot of governors try to open up this week. So this is certainly going to get the infection spreading, and I do think we're going to see within the next 3 to 6 months another huge spike in what put us in this predicament in the first place. So I now believe that the earliest we could see a bottom in the market will be somewhere around the election in November or potentially into December. So tough time for the president to have his economy just in this amount of chaos, and to be put in a place where if he wanted to put the blame on China, it would come at the cost of them likely cutting off supplies. So suddenly we don't have access to a huge amount of supplies we really rely on, from PPE to antibiotics to half of our something like 70% of our electronics. Think about Apple, Walmart, many of the companies that really dominate the S&P 500 are highly reliant on this relationship with China. So that is difficult and puts us in a very tricky place as we head into the election. Now, if you're in the pro strategy, you have most of your cash invested, and especially if you're in the boot camp, as you have the Hong Kong trade, which we are seeing the conflict in Hong Kong rise. Similar to FXI, if they were to revoke Hong Kong's special status and potentially remove the several million citizens we have in Hong Kong, we could see China essentially ditch Hong Kong and move its financial center to Shanghai. This is a very low risk trade that can return 100 to 1 and double your life savings with very little risk and only investing 1%. So that's a boot camp trade we really like. We also have a QQQ leveraged bet on the downside and a long silver trade. So those are three exciting boot camp trades that we have currently on. But the rest of your capital is primarily in this set of ETFs and these protective puts, again, protecting against downside risk in TLT, GDX, USO. Okay, so let's look at our returns. How have we performed compared to the market? Where did we mess up? How can we improve in the future? So let's just look at the timeline. So first of all, in 2019, I was quite certain that the Chinese would not want a trade deal with the US. First in June, so we had this supposed meeting at a G20 summit in July, and I had a small loss because I came out of that summit saying we had a trade deal. By August and September, it came out that, oh, actually, we don't have a trade deal. Just kidding. We're going to raise tariffs. And so we did decently during those months, not a lot of drawdown. And then by October, they announced that we do indeed have a trade deal. And by December, they had signed that trade deal. And so most investors thought that 2020 would be one in which that there would be few geopolitical tensions on an election year, that China was going to abide by its phase one trade deal, and that we wouldn't have to worry about phase two trade deal until after the election. And if that was the case, with a flat growth of debt and potentially global earnings for corporations, it was really a positioning where you wanted to be short bonds and long stocks, especially emerging market stocks. But quickly after the trade deal was signed in December, things went awry by January of 2020. And what I was watching was the US stock market was going up, but the Chinese stock market was crashing. And so I had to ask myself, why was this the case? And so after really digging into it, I couldn't believe what I was finding. There was a epidemic developing. Could this be true? So then the first knee-jerk reaction is go look at other epidemics. Well, you go back to SARS, you go back to any epidemic, it was a short thing that affected very few people, and if anything, really gave you a great buying opportunity and was short-lived. Easy to contain. Okay, so that's what many great investors, including Ray Dalio, really thought about that. But when I was watching, it was growing exponentially and spreading out of China into other countries, and that they were having the same effects. And the result was that these massive countries were starting to lock down all activity, which is economic suicide. And sure enough, it made its way to the United States and caused one of the most vicious sell-offs in a short period of time that we've ever seen. In fact, that's what caused the Fed to come in with $2.5 trillion ahead of schedule. Typically, when we know we have an economic crisis, we want to go raise the debt first at the government level, absorb the losses in the economy, fix the plugs in the cup or in the boat, and then do quantitative easing to incentivize that big banks buy and hold government debt. This time around, they did the rate cuts, push it to zero. We had the crash, but it was so horrific, and we started to see our credit markets deteriorate, especially the treasury market. that they turned around and did massive quantitative easing in April. So that's what caught us off guard, is that typically QE comes a year or 2 years later. And so we have had some drawdown, primarily in our put option positions in April. So that explains the drawdown we're having. But I do want to point out that these put options make money if the market goes down all the way through 2022. So we haven't flinched. We know that the QE is coming to an end, and we know that the next 2 quarters are going to be horrific for corporations. So my analysis remains the same, that the bond market's where you want to park your money, and that stocks should be shorted. Okay, so we have a few hedges to protect us for a few more weeks into May, but in the general scheme of things, I'm highly confident bonds go up, stocks go down, and takes gold with it. Now, should we have jumped on some call options right when we saw this print of $506 billion and then a subsequent $605 billion? Yes. So I fully admit that I missed the boat on this 1-month move in the equity markets. Do I think we should be loading the boat in US equities today when we can see clearly that the Fed is pulling back quantitative easing at a rapid pace, going from 600 billion to 400 billion to 250 billion, and as of recently down to 150 billion? No, I really don't. Now, what brings a small amount of hesitation to actually put in the VIX puts and the QQQ call in the most recent? Well, we do have the ECB and the Bank of Japan still doing QE, and they've announced that they will continue that for a year. Will it be enough to keep the US equity market afloat? I doubt it. Okay, the US equity market is valued at something like $26 trillion. So 2.5 trillion barely kept things running for a month, and now there's really not a lot going for the stock market. Another bullish event I do believe coming our way will be to bail out US oil companies, which could potentially delay a crash. But outside of that, there's really not a whole lot coming down the pipeline, especially if the Fed doesn't keep doing QE. And the reason why we know it's not going to keep doing QE is because no one's going to buy US Treasury products if they think that they are not going to appreciate in value when their yield is absolutely worthless. So that's really the big picture. We have barely budged in our positioning. The last touches that we did this week were a set of VIX puts in case we have a quiet before the storm, and a small QQQ call option in case we do get another pump to really outrageous levels considering the state of the economy. Now, in the pro return with the boot camp, you're just barely trailing behind at a negative 6% return for year to date. Same positioning, you just don't have the Hong Kong trade, you don't have the long silver trade, and you don't have the highly leveraged QQQ trade, which I do believe will bring in very handsome returns for bootcamp members. Basic membership was reducing losses in February and March. We were trying to catch a move like the April move in February and March, but we didn't catch it. And so by the end of March, we built the SPY put position. SPY was at 240. Remember that Sunday it dropped to 220, and then that's when the Fed jumped in with massive, massive QE. So we've held the position, realizing that there is a lot of time premium on our positions. So I do intend again to add to our SPY puts next Friday, so long as the Fed does announce a much smaller amount of QE this coming week and pushing this below that 100 billion per week level. In our buy and hold portfolio, we have a very easy strategy that's designed in multiples of 1,000. And funny enough, it's actually doing quite well in the month of April, only down 0.75%. It doesn't have options. We gave one exception. We did have buy and holders put on 2 VIX puts to help hedge against any risk. This portfolio is currently holding the following assets. So if you don't have multiples of $30,000 or $75,000, you can get the very similar effect as our pro strategy following the basic program with this set of ETFs. And I made a small exception. I added in these two put options to help hedge. Okay, so that's a summary of the full trading plan. Let me go ahead and take a look at the questions, and then we'll take a break to review our product offerings with Dean here. So let me just see what we got so far.
And folks, just want to reiterate real quick. So it looks like a lot on the screen, right? But once you get your email, and if you have less than 30K, you simply do buy and hold, right? If you're between 30 and 75K, you simply do basic, okay? And then if you're 75K or well over, you just do the pro, okay?
You do the pro and the basic trades, yeah. So let's be clear. So the pro trades include all of the basic positions.
Right. So I think that's the kind of the confusion point, Jay, and I'm trying to kind of help everyone understand, right? So yeah, if you're in the pro, you have more than 75K, just follow the steps A to Z, right? And it's just kind of easy. I know a lot of people on trial will kind of go through and place kind of different trades throughout the entire thing. Kind of, guys, I think it's easiest to just really kind of focus on the level of capital that you have, okay, that you're trading, and just follow that plan like clockwork. Now, once you've got that down, you're comfortable. I know people like Kathy, like Karen, a couple others in here will build a pro strategy, and then they'll do subset accounts with smaller accounts, cash accounts, maybe a smaller IRA, that type of stuff. But just when you get started, guys, take the amount of capital you have, simply replicate it, with buy and hold if you're less than 30K. Basic if you're between 30 and 75, and then pro. So you just kind of know exactly where to go. Cool.
Okay, let me get through some of these questions. So Jack says, is the VIX trade for basic members? Yeah, Jack, if it's a basic, if it's labeled basic, that's for pro members and basic members. So if you're a pro member, we only have 40% of our capital in the US equities. We have 60% in the bond market and commodities market. So good question. Joe says, can I take a look at his Hong Kong trade? Yeah, sure. Just email it to me, Joe, and I'll make sure you have that correctly. Okay. Joe says he missed a silver trade. So the silver I have a hold. So Joe, I heard you're heavily investing in crypto. My expectation is that gold, silver, and cryptocurrencies are going to crash extremely hard, much worse than equities. So we're up on the silver trade, but I have put a hold on that to wait for a better entry point for new members. So it is in every single update you get from the boot camp. You'll see the recommended bonus trades, and I have a temporary hold on the silver, as I do want to. If we're going to roll back QE, that's detrimental to any inflationary assets such as stocks, gold, silver, and also especially things like Bitcoin. I know there's a big event coming up and people are going to get hyped into that, but I think you're going to see that as the US equity market pulls back, that we'll see things like Ethereum be a leading indicator and be crashing much harder. Very rarely in history can we see that relationship break where in something like gold does well when stocks aren't. So careful on that. Okay, Joe says he did the Hong Kong trade on trial. Not sure it's right. Yeah, send that to me and I can review that. Absolutely. Jack Tan says he thinks his positions are messed up. No, Jack. So yeah, you would have every position on the screen except for the buy and hold positions, Jack. So you should not have these, but you should have this entire list. Now I do want to point out we're up about 500% on our emerging market put. I still have a hold on that. We'll need to sell that sooner than later. But the more they talk about banning capital flows to China, the better this trade's going to get. So I've been hanging on to it a little bit longer. It's already deep in the money. So we have a 500% return on that. And I do think that can get better for us soon. But yeah, Jack, if you're a pro member, you would have every position on the screen that currently has a buy and hold on it. And so you can see the US equity related positions are in the basic only. And then once we dive into commodities and the bond market, it's labeled pro. Okay, so we have 60% of our capital in ready to be put to work in the pro strategy and 40% in the basic. Now, if you're just a basic member, you really have only 3 sets of trades. You have a call option, that's your upside hedge. You have a volatility play, quiet before the storm. And then you have really the home run returns, the big position is the puts, which we'll add to next Friday. So for basic members, if you're trading between 30 and 75,000, super easy. You have QQQ, a set of VIX puts, and then a set of SPY puts. You're done in a handful of minutes and you can sit back and relax. If you're a pro member, you have the same set of trades, but you're going to also buy really the more important assets, which is the bonds, really the single most important asset that you want to have in 2020. Okay, I'm going back up to see if there's any other questions. Jack says, what happened to the Yang Tex Faz? Yeah, that's still that's for the people with not much capital, Jack. So you shouldn't be trading that portfolio. You should be trading the pro strategy and taking advantage of the leverage the options market gives us. Okay, Steve says, as a matter of the universe, just kidding, CEOs and CFOs will dump everything they can in these bad times. Shareholders never figure it out. So Steve has been with me for many, many years. Always love getting his input. Hope you're doing well, Steve. Jeff says, Trump says the summer heat should calm down the, well, that's not true. So look at Singapore, Jeff. Go look at Singapore. They have the worst outbreak, the longest lockdown, the best healthcare system, and 80 to 100 degree temperature from night to day. And it is growing rapidly. In fact, they did testing. It takes something like 120 degree temperature for 30 minutes to actually melt away the protective envelope around the virus. Jeff says market crash 90% in the 30s. So I think that the Fed will buy stocks, but not until we get right below the 2009 high. So I don't think we'll go as low as the 2008 high. I think we're going to touch right below that 2008 high and not as low as the 2009 low. And the Fed comes in and buys up equities to put a bottom, which is realistic because they could afford to buy the stock market and support it if it was worth something like $10 trillion. You know, if they add another $2 trillion to really bottom out the market. But if they try to do that at this level, they'd have to be putting $5–10 trillion into their balance sheet. And you got to realize they're also trying to support the real estate market. They're trying to support small business. They're trying to support employment. They're trying to now support the pensions of all the states. You know, you've got something like a couple 100,000 people who are retired making 100,000 or more a year. Some of them making 300. So it's just America's broke. That's really what you need to figure out. And for it to continue its financing, it's going to do that by growing its debt, crushing yields, making bonds appreciate, and printing money. Tony L, the VIX options in the pro portfolio or just the basic? It's for both. Yep. So to make life easy, guys, really the strategy is the basic strategy is just US equities. It's a US equities only strategy that can go long or short, and also will play the volatility, which is again based on the S&P 500. For pro members, this is 40.
Just options currently.
Yeah. Now we will have to liquidate a lot of our options for both strategies when we want to buy up companies on the cheap. So I expect us to have no less than a 50% correction, and then to be able to buy up stocks and sit back and have the easiest returns in history. Okay, so healthcare, biotech, medical device, e-commerce, and then expecting military to grow. Just a dead obvious trade. But again, not until the entire market has been repriced. So I think if you go buying Gilead or Moderna or any of these promising companies that might have a solution, you're going to figure out that unfortunately they are tied to the general market. And even though they do have some potential huge growth and massive profits if they can solve this problem. And also, you got to realize these companies are controlling the CDC. These companies are on the boards controlling everything coming out about what's going on. So you know for sure they're going to funnel as many billions of dollars, probably trillions of dollars into their companies that's being issued by the government right now. Okay, so I'm still getting back to the top. Okay, coming back down. Boris says, do the TLT pay dividends? It sure does. I haven't added the dividends to our returns yet. I will get that back. Okay, we got
beautiful monthly dividends too. It's
yep.
You gotta love those monthly dividends.
Okay, Jack says, where's my VIX protection? Okay, so your SPY puts are out of the money, so we do need a big move down for us to create profits on the VIX. The TLT in general is downside protection against any sort of negative move in stocks. So the TLT, they don't always move on the exact same moment. Okay, so in general, your TLT and your SPY puts and your FXI puts are going to do very well if your VIX puts are being wrecked and your QQQ calls being wrecked. Okay, so we have short duration on the upside part of our portfolio. So we have a short-term QQQ call option and a short-term low volatility position. In general, though, we have long-term positions predicting, again, economic turmoil, bad profits and earnings. Companies are going to make less this year and next relative to the last several years. So again, that's why we want to be short stocks, long bonds. DD says, where can we learn the QE announcement later today? So there is a Federal Reserve Twitter handle, which does announcements. So that's a good one. And also Zero Hedge tends to have people who sit there and wait for that announcement and publish it. Also a handful of Twitter accounts I follow. If you want to follow at Generates Income, that's my Twitter handle. I retweet anything that's critical. So the second I see it hit, I will retweet it. If you just wanted to follow one Twitter account, follow Generates Income, and you'll get the most useful information real time as I retweet all day. Okay, next question. Kev says, what's your take on buying calls or inverse real estate ETFs? Yeah, I want to have time to investigate the commercial real estate. The defaults happening in the commercial real estate are just skyrocketing. It's very alarming. Carl Icahn's making out like a bandit. Have we missed the big move? I'm not sure about that. How can we do it? There's something called the CMBD index, which I'm not familiar with. So I've been considering putting the research into that. But in general, our strategy is going to do extremely well if commercial real estate or private real estate, for that matter, implodes on itself. So we're well positioned for a crisis. So I wouldn't worry about not making money if things come tumbling down. Really, our concern is hedging against further upside risk from central banks pumping the market when quite clearly this is the worst economic crisis we've had in the last, you probably have to go back to something like the Black Plague, which I believe was I bet Ignacio probably knows a history on that. But to find something of this magnitude, you'd have to go very far back in time. I'm not sure the Great Depression's even comparable to what's potentially coming down our pipeline, especially if my modeling is correct and we can't get a vaccine. We're going to switch gears after Dean reviews the strategy and the product options in a minute and deep dive into how the heck do we get out of this problem? How do we save America? And what's going to happen between US and China? So we'll take a deep dive into that soon. Jack says, what happens if I'm already in Yang, Tex, and Faz? Should I take a loss? Well, Jack, if you want to have a small portfolio following the buy and hold, just make sure to follow it completely and not partially, and realize it's highly correlated to our pro strategy. So if you like that and want to run multiple portfolios, go ahead. I know a lot of our members do that with different accounts. Some people will go take their, like a smaller, say their child's little college account, and maybe follow that with the buy and hold, and then they'll do their bigger portfolio with our much more advanced strategy. The drawback to the buy and hold with the inverse ETFs is you don't get the extreme leverage of options. So the options market has allowed us to to really have some huge returns over the course of time and be able to protect against unexpected risks. So there is some big advantages on that. Marlene says, is the buy 5 VXX puts a new trade? I don't have that in my portfolio. So here's the set of trades for the VIX. If you don't have them, you can build them today. So it's not new, but it's still a trade I endorse and listed as a buy and hold. And if you are doing a 30K size, as I know you are, then cut this position in half. So good question. Rocky says hold, don't buy. Okay, so Rocky, for example, we have a 500% return on the 42 strike 515 emerging market put. I'm not endorsing new members to buy that position today, but I'm not telling old members to exit that. In fact, we replace that with a better, more targeted, call that a sniper shot. So emerging markets hits, Hong Kong, China, South Korea, Russia, India, the whole area ex Japan, whereas FXI is going to laser focus your intentions on China, which I do believe will be the target of the United States, especially leading into the election and maybe more aggressively after the election, assuming the current president does win the election, which is questionable with the problems he's having to deal with. In fact, he was saying that he thinks China's done this to force him to lose the election. So that's an interesting comment yesterday. Robert says, do both groups own the TLT and GDX? No, so only the pro members have the TLT position. And the reasoning is because to follow the pro strategy, you will need lots of 75,000. And so the basic strategy is really for those who are unfortunate to not have that much capital to put to work today. We're also temporarily showing the full trading plan on each meeting until we do begin the next big leg down to really make it easy for pro members to see daily what's going on. I know that people are getting impatient waiting for our bearish portfolio to shine. So I want to be able to update you guys, especially daily. And for new people coming on board, it does give them a daily opportunity to consider, do I want to be trading like a professional hedge fund manager, playing bonds and stocks and commodities? Or do I want to start off slow and do something I'm more comfortable with, which is just trading US equities? Okay, Alex says, question, while I'm building the basic portfolio, should I use the spreadsheet as per the bootcamp explanation video? I would, Alex. Yep, it's kind of like doing your dishes. If you do your dishes as you go, your kitchen's always clean, and it takes you 5 minutes. But if you're a slacker and you don't do your dishes as you go, well, all of a sudden you get a traffic jam, you don't know what's where, and things become much more of a problem to get in there. So yeah, I'd absolutely use the spreadsheet. And for anybody interested, when you do join, you get a copy of our platform, which allows you to track your returns per asset class on a monthly basis and organize it in a format that I believe is far better. So in 10 years of managing every guru under the sun, from the mad hedge fund trader to Timothy Sykes to Jason Bond to Agora, you name it, I have managed those guys, seen what they've done, watched how they present their content, seen all their dirty little tricks, and I can tell you without question, our platform for managing your portfolio is dramatically better than anything I've ever seen. And so it's not supposed to replace your brokerage. This is going to keep you organized and keep you organizing all your trades in the right spots. So we have a tab for each asset. And then in each asset, we break it down by the type of trades. We have stocks and dividends in purple. We have option writing. So if we're selling a call option or a put option, it's in the option writing area. We have real-time profit loss of our open positions. If we're buying options, whether a put or a call, it goes in the yellow area. And after we close them, we can put them over here in this area. And so on your summary tab, this does allow you to see your profit loss per month broken down in total as well as per asset, and a summary of how your total asset allocation is organized. So absolutely love it. Now, do you have to do it? No. Every day you get a really simple, easy summary. Here's what you should have. It's based on lots of 75,000. I'd say half our members love spreadsheets, like accounting work, want to see it organized. The other half don't want to do that, and they're perfectly happy just watching this report every day and then just lining it up. So totally optional um, and really up to you. Okay, Marlene says I have a 250 put and USO is now trading at a higher price. So the split took care of you, Marlene. You have nothing to worry about on USO. I'll spend more time covering what happened with the split. But bottom line is no change. My target to sell USO is going to be in the $40 to $60 range and then hang on to that put. I think we're going to see the government take some pretty strong measures in May to benefit the USO ETN. So we'll take a look at that in a moment. Gary Barber says he bought 4,000 shares of USO at 385 and $44 puts after the H1 split. Okay, you're good to go as well, Gary. You have no change. You're absolutely covered. The worst case scenario is don't touch this at all. On 1/15/2021, your broker will automatically sell your 4,000 shares for a value of $4. So you get $4 per share, and you'll just lose the value of your put. That's the very worst case scenario for your USO. Best case, government intervenes, USO spikes. We're going to sell USO, but remain long the put because we do anticipate that, again, oil will come crashing down alongside stocks, crypto, gold. All of these inflationary pro-growth related products are in some pretty rough times for the next at least 6 months, but realistically it could be much longer. Mike says you can't get off the phone to focus. Well, good thing you can go to your email and click the replay button at any time, guys. So click here to replay webinar buttons on your trade alert. So you can replay this as much as you like. Ram wants to repeat the Twitter handle. So it's @GeneratesIncome. And Ryan reposted as well. Very good. Jack's asking if the VIX and QQQ are negative. Yes, those positions are negative. Today, TLT is a bit below where it was at 170, and our SPY puts are so far out of the money that we will need a much larger move for those to generate returns. So we are having a little drawdown at this point in time, Jack. So you're not making any mistakes. You are following the program, and highly confident that we will end 2020 extremely profitable by not getting tricked. Not getting tricked by the Fed and not getting tricked by the media. Joe says in his Thinkorswim account, it still says NS at the end of USO's puts. So yeah, they are reporting two sets of options now, Joe. They're doing the old ones before the split, which is what you have, and now they're selling new ones. So it's confusing because your USO looks like it went to a different strike, but what they did is reduce your shares. So they've kept you having the same amount of 4-strike puts, but those puts only protect 12 shares now, and their relative value is 8 times that. So $32 is what you'll receive on each share of USO if you hold to expiration. Now the documents we're going to cover are in the webinar teaser. So I'm trying to incentivize you guys finding the webinar teaser, clicking this doc daily for a lot of content on a daily basis. This is not all the YouTube content. I'm saving that primarily for our Bootcamp Tuesday special. But I am going to provide you every article I read on a daily basis so that you can go do your own research and also understand how much work goes into this product. I do want you to realize there's a tremendous amount of research. Tony says, with a 5 to 7% drawdown year to date, do you have a feel for whether the portfolio will require a change in allocation? Yeah, no change. So our drawdown is almost exclusively in 3 positions: the QQQ call, the VIX puts, which again expire very soon, and then we have anywhere from let's see, 2 months on the June put, and then after that it really jumps way into the future. So we have a lot of time on our SPY puts. So what I do anticipate is to add to our SPY put with probably a 250 strike with a pretty hefty position, and I'll look at which exactly expiration I want to add. Other than that, yeah, I'm still highly confident in those put options, and I just don't think today is the best time to readjust those, as again, it would be the worst time, assuming that the market's getting near a top and ready to roll in at some point in May. Okay, Joe says, appreciate the hard work. Oh, well, my pleasure, Joe, and I got a lot more content for you, so don't go anywhere. Okay, Jack says he's loading up on the QQQ and the VIX. Okay, so now again, some people go put random trades out. They don't follow the allocation. They start playing with the expiration date. They start moving strikes around, and they take part of the trade, not another part of the trade, and then they come saying, "Hey, what should I do?" And unfortunately, I can really only support the trading plan I provide. So I do not recommend trying to gamble with which part of the portfolio is better, changing strikes, changing expiration dates. That's a good way to take extra risk that's not warranted. Sure, but yeah, when you say the word "I'm loading up on a certain position," that would tell me that you're doing more than advocated, which would be a mistake. Tony's saying, can we put a percentage allocation per position? Well, the trick with that, Tony, is that we can end up with the same trade being recommended for a period of time. And so that relative percentage would go up or down. So I'm doing my best to make sure it's quite clear what makes sense and what doesn't make sense, and trying to adjust that as frequently as I can. So I understand what you want, and I'll do my best to achieve that. But I'm not basing it on a percentage of the portfolio, because I do know those prices are moving around. And in general, I'm trying to just catch a big move and have a good asset allocation. So for new people coming in, this whole position's about 3%. For old people, this was 10%. So that has dramatically changed the asset allocation. Ron says we have drawdown on USO. So USO, I want to be really clear. You have the maximum loss on USO when you place the trade. So that was by design. We actually wanted the biggest loss possible when we put that trade on, and that loss is realized by buying an in the money put. So anytime you buy a security and then buy a put option that has a higher strike than the value, you can just hold that put to expiration, and the broker will sell your shares for the strike, and then you lose the put option premium. So yeah, we do have the maximum loss on USO the second we put it on by design. That was the point of buying the in the money put. Okay, great. Well, we got a big crowd today. Let's see. I'm going to go ahead and let Dean do a quick overview of our programs so we get him back to all his appointments, and then we will do more Q&A and then dive into the bulk of our content today. So we've only skimmed the real content that I wanted to cover today.
All right, thank you, Jason. Appreciate it. And sorry for the scratchy voice today, guys. I have really bad allergies in the springtime, and it creates a little bit of a scratchy voice box for me, so I apologize. And just real quick, guys, I'm going to go ahead and post this into the chat Okay, so if you're on a trial, you can actually just click this link and get started with us. Okay, it's really cool. You will get your access to that $10,000 bonus with the boot camp for 30 days right after you sign up. Okay, but this is our page right here. Okay, and when that pops up, that will actually get you directly to me. Okay, so if you do see that pop up when you're on, feel free to interact with me if you're on a trial. Okay, now, so I'm going to start at the bottom actually with the boot camp. Okay, so if you guys are looking to learn how the financial system works, okay, how to think like us, how to understand how to apply certain trading strategies to market conditions, you're going to want to look at our boot camp. Okay, it's really cool. It's super interactive. You're going to get a lot of kind of, more kind of focused time with Jason. Okay, you get additional content that's just phenomenal to review on Tuesdays, and then on Thursdays you do your live module presentations. Okay, and the really cool thing that goes along with the boot camp too is you're going to get access for life to it, and it's going to take us guys probably a couple of years to build out all that content, right? But then you're going to have access to it forever. So if you ever want to go back and reference anything, you can do that within the members area. Okay. And the other thing, guys, on the boot camp that's important to know, we do not give you part of that as the trial. We spend way too much of our time creating the content in there to give it out for free. But once you are a paid member, you will have access to that. Okay. And if you do the boot camp for life too, you also get a year of the pro portfolio at absolutely no cost. Okay. So pretty cool way there. And best way, if you're looking to kind of take yourself from beginner or intermediate to a pro level of trader, it's a beautiful thing for you. Okay, next is our pro portfolio. Okay, this is great for investors that have a minimum of 75,000. Okay, but typically used by people with much more. It's going to really show you guys how to optimize your portfolio and your investments like a hedge fund manager. Okay, take all the risk out of the market when you possibly can. Okay, and really trade the 3 best asset classes that matter. Okay, typically, but if we get a really, really good opportunity, we'll take advantage of it along the way. Okay, and like I said, the pro portfolio is kind of really for people that have at least 75K or much more, and is literally being used by people with anywhere from 75 to 100K up to in excess of multi-million-dollar tranches. Okay, next, guys, is the basic options. Option. You currently are just trading options. We'll tell you when to go back and buy the market, but it's not going to be for a while, guys. But if you have between 30 and 75K, the basic option is beautiful for you. And I will mention, if you upgrade to the basic or the pro portfolio today, you will get 30 days access to the boot camp for free. So it's really cool, guys. You can go in, study things over the weekend, get a better understanding of the financial system, how it works and why in Module 1. Look at the history of the market. Okay, that's a phenomenal video. And to me is more valuable than the cost of than the pro or the basic portfolio. I've relied on that video now 5 times, guys, to go back and watch it to really understand where things are in the market, how they work, and how the central bank literally controls everything. Okay. And last but not least, if you have less than 30K, you can use our buy and hold portfolio. It doesn't use options, and it's great if you have less than 30K. All right, and so that's it, guys. If you do have any questions before you get started, call me. My number's in the top right corner of the screen. Look forward to working with you guys, showing you how to build massive wealth in this type of environment. It's tough. Your financial advisor is not going to tell you how to show you how to short the stock market. Most of them won't even let you frickin' sell stocks. Anyways, so we look forward to taking you out of the cookie cutter Wall Street, crap scenario where it's always a buy. That's the worst thing you can do in this scenario, guys. You want to take your capital, expand it, right, with our short positions and our risk off positions, expand that foundation massively. Okay, and then go back in and buy the market when the blood is flooded into the streets. Okay, we look forward to showing you how to do that. Look forward to helping you and your family grow your wealth in the safest manner possible. So thank you guys for your time. Appreciate it. And the number is in the top right corner if you do have any questions. You guys have a great day. I'm signing off for now, Jason.
Okay, great. Thank you so much, Dean. Let's go ahead and take some live questions with audio, starting with Murray. And Robert, we're going to get you your spreadsheet sent, but you said you don't know your password, or you don't know your portfolio builder password. So yeah, so you're going to have a Gmail. Murray, you want to unmute your microphone?
I'm here, but I haven't been following real close. But I think the promise of the future is looking very rewarding. I can hardly wait for the time to move on to experience those benefits.
Okay, good. Yep, it's been a tough month to watch that stock market just racket higher. I feel you.
Yeah, this is unfortunately, I guess this is the first time you've had such a drawdown versus the consistency of the past.
Yeah, that's true. And I'll go into why we took a larger put option position. What was the risk reward, and why I wouldn't change that. If anything, we would have wanted to buy some call options. Okay, great. Any other questions, Murray?
Not yet. No, I just placed my Hong Kong.
All right, nice. You got that one on.
Yesterday.
Very good. Over at Thinkorswim?
Yes. Well, I actually had to call in because my Thinkorswim app was not working on my phone because the click on the side that had to connect to it wasn't working. I've got a problem with my iPhone. So it's a mechanical problem, or it blocked me. So I had to place it through a person at TD Ameritrade Forex trades.
Okay, so you just
and they were very helpful, very cooperative, and saved the day when my phone couldn't do the job.
I think a lot of people just called in that order. Very good. Okay, great. Let's see. Marlene has a question. Let's go ahead and take her question next.
I forgot that I had raised my hand earlier. That was from earlier, and then I typed in the question. So, but we're all a bit down right now, correct? In our portfolio. I mean, that's just.
Yeah, but again, I want to say we have open drawdown, not closed drawdown. So it's not like we have lost in the long run, just a temporary drawdown primarily in those SPY puts. Yep.
And I'm holding TLT puts and calls, not the ETFs though. Is that okay to do?
Yeah, that's a good way to try to get some of that pro action without having to put all the capital into that position. So I do like that. Yeah.
Okay, cool. Thank you.
You may not want the put. The put's really designed to protect you against the ETF losing value, and would do less to protect your calls.
Oh, so don't do you would recommend the calls, but not the puts?
Yeah, if I was trying to kind of grab some action in the bond market for a smaller account, I would just use call options and not the put. Yep.
Okay, thanks.
Great question. Let's go with David next. And if anybody else would like to speak out loud, please raise your hand. Now's the time to get you on there before I go into a lot more content that I do want to get through. David, you need to unmute your mic. Let's see. Ryan, can we, okay, David says no question. Ryan, let's send Robert the spreadsheet tutorial link if you could, please. Pete, go ahead. We're going to go ahead and unmute your mic.
Okay, am I unmuted, I guess?
Yes, sir.
All right. Hey, thanks for your help. You really are a wealth of information, by the way.
Oh, very kind of you to say that when we have a little drawdown today, so appreciate the
That's okay. That's okay. I did, even though I'm a basic member, I did buy 100 shares of TLT. And I've got the put to protect the downside. But I did buy the 157 call, but I think I might have gotten a little too late. I don't know. There is a drawdown on that by almost 300, I guess $300 on that one. But do you recommend me just holding that to the May 15th expiration?
Yeah, I would follow the trade. If you guys are dabbling in some of the pro trades, considering, going from a basic to a pro strategy, I would definitely follow the trade alerts for buy and sell triggers. So yeah, in general, we don't really want to take a loss at the worst time. So yeah, I do think we can hold on to that position and
So,
see it appreciate.
so if I hold that to expiration,
I'm not going to be holding it to expiration, so I wouldn't say that.
okay.
Yeah, we'll need to probably sell that. So next Friday I'm going to look for the Fed to reduce the growth of the balance sheet again with their announcement today. If that's the case, and depending on the size of that, I am very tempted to really finish off the portfolio in terms of the last touches that we're going to need for the next big move in the market next Friday. So that would involve increasing risk on the SPY puts, and then at the same time, increasing risk on leveraged TLT calls. So I'll be looking at strikes that are 175, 180, 185, and maybe even probably that'll be the next three I'll buy with a bit more time premium and potentially adjust what we currently have in our portfolio. As I do with this massive support. I would have thought TLT would have got hammered with this very ridiculous jump in equity prices, but it didn't. It built support. So now it looks like we could be moving up our profit target. Originally, I had that as 180 as, gosh, we should have took profits last time at one. We had people making a fortune at the 180 level on the TLT. And I thought the market would keep crashing. So I told them to hang on. I said, take profits if you got bills to pay. Otherwise, I'm hanging on. And market kept crashing, but it was crashing so hard that people had to sell their treasuries to not go into insolvency. But what happened? TLT flew right back up and is building a lot of support here. So I'm actually getting more bullish on an initial target for where the TLT could end up in the next leg down.
Great. So if it stays flat, say through expiration of that 157 call, it's all intrinsic value in there now, right? I mean, it's
right.
So if it stays flat, this price is gonna basically stay the same as it is today until expiration.
Well, you'll lose a little time premium value. If the TLT goes up, it will appreciate. If it goes flat or down, it will lose value.
Okay.
With a call option, yep.
Okay.
Great question.
Great. Thank you very much.
You're very welcome. Anybody else want to unmute and ask any questions? Okay, great. Well, I'm going to keep an eye out for anyone else who has commentary. Go ahead, Jack. At this point, only questions, not commentary, please. We will have a time for commentary towards the end, but I would like to really review each position, the charts, the methodology. Okay, yeah. What's your question, Jack? Please.
Yeah, we bought the VIX, the 30, the 28, and the 32, and all of them based on a $300,000 portfolio. I'm lost at $8,000 something. Is that correct?
You would like to see my
No, I mean I'm in a position where it is lost, each one of them. I mean,
yeah, we're down significantly on our VIX put options.
Okay, I just want to make sure that we are because I've been looking at my total portfolio keep losing, so I just want to make sure that I'm in the right position. I want to go follow you 100%, but then it just distracts me so much. But anyway, we talk about it after the class. But I just want to make sure about that. And also the QQQ for the 4 contracts is also at the loss, right? Basically.
Yes. So these bullish positions are down because S&P 500 is down today. So it's down 3%. So yeah, your bullish positions are not winning when the market's down 3%. That's correct.
Okay. All right. So I'll talk to you later.
Okay, very good, Jack. I'll definitely give you a call
Thanks.
to review your different positions. Okay, great. Let me go ahead and switch gears to some content, and we'll go from there. So yeah, so just to be clear, we were up significantly on our VIX. Yesterday, Amazon came out, and although they had a big growth of revenue, their cost, their labor cost, is getting out of control, and they are putting away something like $3 billion to deal with the pandemic. Another disappointment, Apple came out essentially saying they have no clue what's going to come in the next 3 to 6 months, and investors did not like that. So that did make the volatility index go up. So these have an expiration of 5/8, 5/15, 5/22, and I do still believe there's enough quantitative easing in a worldwide basis that these can still provide value in terms of cushioning the weight for what we're really expecting. That's a big leg down in equity markets. Craig says, with the adjustments you're making next Friday to the SPYs, will I be able to follow the whole portfolio? Yeah, absolutely. You still will be able to follow the full portfolio, Craig. And Brian sent you your tutorial video on the spreadsheet, Robert. So that's a really good one. Next Thursday, my goal is to deliver a written version of that with a cheat sheet. But you watch me, I think it took 20 minutes to build the entire portfolio out from A to Z on every single tab live with the crowd asking questions. That was a good video. Okay, let's go ahead and switch gears and look at some content. So yeah, what a crazy world. Let me start off by looking at the equities markets. Okay, so let's start off right here. So we'll start off by evaluating the stock and bond market, and then we'll go down to the smaller positions from there. So the big picture in our forecast is really twofold. One, companies' profits and earnings are going to be hurt for at least this year, next year quite likely as well. And this is primarily due to a change in consumer behavior, and also from governments having to lock down entire nations for prolonged periods of time, as well as a risk that they have to continue to do that and also change the way businesses are allowed to operate, primarily reducing the amount of people in a store at any given time, and also making a law that you have to wear a mask. So in general, this is not going to be good for commerce. And so what happened? We went into this lockdown, and now we're giving the governors the power to reopen their economy with a set of guidelines and restrictions. And so what happened when they did that? Well, they went and passed $2.6 trillion stimulus plan. They gave everybody massive unemployment benefits to stay at home. So a lot of people are now making more money not working than they are working. And they essentially just try to freeze everything. They're saying this is not their fault and that everything's going to be just perfectly fine when we open back up. But the catch is the restrictions are that you have to keep people separated. You have to continue the social distancing. They're wanting masks. So a lot of business models just really don't work like they used to. Primarily anything that has a enclosed area with a group of people. So off the top of my head, concerts, movies, restaurants, retail stores, things of this nature are going to be dramatically impacted in a negative way. So that's not too hard to calculate. Okay. Now we're starting to see supply chains have issues. So companies like Apple may not be able to get its products created. In fact, I like to call up my business Verizon account just to see what they have in inventory. And I can tell you it's been progressively worse week over week as they run out of supplies. So they are down to very few iPhones, and many of the accessories are completely out of stock. So we're starting to see the supply chains break down. Furthermore, the food industry is literally killing livestock. The labor forces are starting to boycott working. So we really have a lot of nightmares for companies to create profits, and that's, I think, quite easy to see. So with probably the biggest I mean, we've never seen a country lockdown for a day, much less a week or a month, much less the entire or the majority of the developed world do such an action. So what what did the stock market do during this period? Well, we touched right above the recent high of 2018, not as high as we got into 2019, but still, the stock market's currently trading right around this range where companies were valued before this mess happened. So you got to ask yourself, does that make sense? Are companies going to make as much money as they were last year or the year before, this year or the year next? And so my calculus is that no, they will not. In fact, many companies are going to be driven to bankruptcy, and this is going to cause lots of unemployment. So if 70% of the U.S. economy is consumer spending, you just really got to ask yourself, does this really make sense? Okay, so no, obviously it doesn't. The stock market shouldn't be going up when we're having depressionary level unemployment and when businesses are not allowed to operate. So clearly this is a silly move up when you just look at it from that standpoint. So why did it go up? Well, central banks printed just on the United States side $2.5 trillion to pull that off. Okay, so we can understand that. Now, I'd like to take blame for not playing that move up. It's a one move up. We know to watch the balance sheet week over week, and we didn't play this move up. We didn't adjust our puts right away, and we missed this big move. So I know people don't like missing that. Next question is it going to keep going up? Are we going to new highs? Are we going to stay in this level? Are we going to trade range bound between 280 and 340? So that's the next question you really want to ask yourself. Okay, so that's one big question we really have to ask. And then to put things into perspective, I like to look at 2008 and the dot-com bubble. So real estate crisis, and then a really just a tech crisis in 2000. Okay, the amount of money that was malinvested and absorbed by the government during both of these were minimal relative to the losses we've already incurred in the first 2 months of 2020. Okay, and if what I expect is going to last for no less than 6 months and potentially 12 to 18 months, then we still don't know just how much economic loss has really been incurred. Okay, so this is going to be coming out in the next 6 to 12 months. And so I think you're going to see some pretty horrific earnings over the next 6 to 12 months from the big companies that have driven this up. So at the end of the day, what could stop a stock crash if I'm right? If these Fed's going to stop doing QE and let the market find a valuation? Well, I think they will do that once we look at the bond market. And I believe the Fed's going to have to step in after we get to a much lower level. So I do indeed believe we are going to get very close or go below the 160 level on the SPY. And at that point, I do believe the Fed could come in with either negative interest rates and or some quantitative easing that involves actually buying stocks through the Treasury, which is how they could get through that legally, which again, they're not supposed to be buying corporate bonds, which they're already buying. So this is really the target that I think is where we're going to end up and where I want to start buying equities. Okay, so timeline, most crises are lasting about a year. Dot-com bubble was 2 years. So to think that the worst is behind us and it was a 1 month crash and the magnitude of this crash is nothing less than 10 times worse than past. Again, I just think that's very foolish. So do I regret us not playing some call options right here? Sure. We saw the Fed print these massive prints. Okay, should have put 1 and 1 together. Do I think now is the time to get overly bullish and predict new highs because we've expanded the balance sheet? No, I don't. Okay, so that's my look at the S&P 500 and some targets on that. So the next question we've got to ask ourselves is what's going on in the bond market? And so here's your TLT ETF. And what I really want to point out with the TLT ETF is a few things that you can point out with just a glance at the. So 2008 crisis, I want to point out that the TLT went from 90 and spiked to 123. In 2015, when China nearly collapsed its real estate market and the world economy went from 100 to 140. And during the threat of a trade war and then the coming crisis we just witnessed, we went from a value of 114 to as high as 180. Okay, so I'm going to argue that the stock crash is just beginning and the rally in the treasury market is just getting started as well. Okay, so that's the big picture, is that the TLT has a relationship where it tends to go up when the stock market goes down. In fact, very rarely does that relationship break, and most of the big money players in the world rely on that relationship. But what's actually making the TLT go up? Is it just because the stocks are crashing, or is something else driving this action? So I do want to point out another fact, and that is that the government looks at crises as an opportunity to, guess what? Increase its budget dramatically. So what I would like to point out is that perhaps what's really driving the TLT higher is an expansion of debt at an accelerating pace during these periods. Okay, and we'll look at the mechanisms that drive this higher and how it incentivizes major banks to buy government debt when they're growing their budget at a accelerating pace. Okay, so that's really the key factor to predict is, will the government grow its deficit at an accelerating pace? And if so, what effect will that have on stocks and bonds? Okay, so that's your TLT chart. Now we're going to layer these two together. Let me change the color on that. Okay, so here's the TLT in the orange line and the S&P 500 below. So we can see when the stocks crashed, TLT was behaving beautifully. But this crash was so vicious and the oil market was collapsing at the same time and everyone was so unprepared that it actually caused a relationship to break down. So we can see the TLT crashed right here as the SPY crashed at the same time. So this is where we missed out on pulling some major profits out of the market, massive profits. But then what happened is also highly unlikely to occur, which is the TLT went up back in value at the same time the stock market went up in value. So why did that happen? So we'll come back and answer that question. But let's see, does that work in other periods of time? So let's just zoom out a little bit to the monthly chart. Okay, so here is the unfortunate TLT can't go back to the dot-com bubble. You can see towards the bottom of the dot-com crash, TLT is appreciating. Now we had a healthy run up in the US stock market. TLT was pretty much flat. During the 2008 crisis, TLT shot up. Okay, and then right around here at the top is in November is when they began announcing QE. So sure enough, once they do QE, bond yields come back higher and bond prices go back down and the stock rallied. So notice that typically when there's quantitative easing, stocks go up, inflationary, bonds go down. Okay, so that's a healthy stock market. Bonds go down, stocks go up. What happened in 2008? Banks lent money to people they should not have lent money to. Okay, that wasn't too bad. 300 billion in bad assets, 25% delinquency. But they took those mortgage-backed securities and wrapped them up into packages, gave them a AAA rating, and then began selling them and leveraging them into to pension funds and all over the financial space to the tune of $3 trillion plus in losses that were incurred. So in 2007, leading into this in 2008, we had bankers realizing the entire financial system was about to implode, that the bankers were pulling out as much cash between meetings from the New York lobby ATM machines, and we can calculate what the loss that the government had to swallow for this crisis by looking at the growth of the balance sheet over these years. It's about $3.5 trillion right out the gate. Okay, but what was their strategy for dealing with these bankers and their bad investments they'd made, loaning money to folks they shouldn't have? Did they let the banks go bankrupt? No, oh no, nope. They did something else that they've done for the last century. And here's what they did. They said, okay, we've got a big problem. We've lent money to people we shouldn't have. The entire financial system is going to collapse. The banks are going to collapse. What should we do? Well, let's make the government pay for it. That was the plan. So that's where we went and did the game plan. So they cut rates to zero. Okay, that means your central bank is going to loan money to your primary bank, JP Morgan, the biggest in our country, for free. Okay, now the plan is they have to buy the US government's debt it issues. So they're borrowing from the Fed for free and picking up a treasury that has some sort of yield. Nothing that attractive, but that's not why they're buying it. So Fed lends money to JP Morgan. JP Morgan lends money to the government. Government takes that money and fixes the problem, bails out wherever the losses are, plugs the holes in the ship. Okay, once the problem in the economy is resolved, then the central bank comes back and says, we're going to do quantitative easing. What is that? Well, that's where they buy those treasuries back from JP Morgan for a big fat profit. Now that profit's derived by the yield traveling lower, making the relative bond appreciate. And then what does the big bank do? Well, they go and buy stocks half off. Okay, so it's a great deal. The banks can go create a crisis, get bailed out by the government and the central bank, profit from that, and then turn around and be positioned to essentially create the floor in the stock market, guaranteeing they make another profit. It's absolutely ludicrous, but this is the system we live in. So I do not anticipate that this crisis will be dealt with any differently. Now, again, the one thing that has happened that's far different this time around versus last is the magnitude of the losses in the economy are at least a multitude of 10 times worse. We'll get a figure for just how bad this is in the course of the next 5 years by watching the US debt grow and also watching the Fed's balance sheet grow. I'm going to ballpark it at $10 trillion in losses over the next 3 to 5 years minimum. So far they've promised 2.6 trillion in stimulus. They haven't sold that debt. They've just printed it. So they still need to offload this debt. They want to sell it to foreigners and not just to JP Morgan. So they did a quick hit of quantitative easing to slow down the crisis. We can see clearly that they are slowing down the quantitative easing, and I do believe that that will need to come to an end. Why? Because you can't incentivize buying and holding US government debt if it's not appreciating. And the only way to make it appreciate is to stop the quantitative easing and keep rates low or into negative territory. So what I expect happens next is another big vicious crash, negative potential rates on the T-bills, maybe the federal funds rate going negative. And then once we're at really a point where the government's confident that it has gotten the economy to a healthy level to flip on the QE, put a bottom in stocks, and then get back to work as normal. So timeline on that really involves us understanding what's causing the economy to be slowed down. So that's why I spend so much time trying to predict the future of the virus and what the government's going to do about it. Okay, so that's the big picture. Bonds go up, stocks go down, rate cuts, then potentially the Fed buys stocks at much lower prices to put a bottom in. But I don't think they'll do that until we've really resolved the economy's issues. Okay, so let's now look at this. This is your Treasury direct.gov. Where are we going to put the $2.6 trillion stimulus plan on top of the $1 trillion deficit we already had planned for this year? Well, are we going to roll it over every 13, 26, 105, 119 days, 42 days? No. So the short-term solution was that they went and sold, I think it was about $1 trillion of T-bills in the last month, which are short-term debt. And most of this was picked up by the Fed. So we saw those massive prints, that 600 billion, that 400 billion. Well, that's how the Treasury got $1 trillion in its coffer to start paying for all this stuff. But we really have not sold this debt to anyone who wants to buy and hold it. Okay, we just literally put it in the Federal Reserve's balance sheet, which is funny money. That's like taking money out of your checking account and putting it into your savings account and thinking you created money. Okay, you just moved it from one place to the other. So what needs to happen next is to roll this debt into long-term debt. Okay, and that will be announced in this category right here. And that's what we're playing in the TLT. So we really want to see the short-term debt rolled into the notes and the bonds, which again, if you are going to lose your job and go take out a big loan, what do you think the bank would normally do? They would hike up rates. Okay, but the whole world knows that the spiking of interest rates would cause a stock crash. So they front run that and buy the bonds before it spikes, and they dump their stocks because they know what happens. Okay, so that's exactly what I see happening in the coming weeks. Now, we'll see just exactly when they're going to grow the auction size of the bonds. So far, they've been timid, doing 18 billion a month. And again, this is an $800 billion asset class, a 30-year treasury. And they've told us they want to price it in on the long-term duration. So what comes next, I believe, will be a growth of the issuance of the bonds, which will have the hidden effect of spiking yields. But because the banks know that, they're likely to gobble it up, fight over it, and ditch their liquidity into stocks. So I do believe that's coming very, very soon. And that's being shown to us by the Fed reducing QE. So that's what I think is coming up next in the bond market. And just that in itself can be the primary driver of the stock market crash. Okay, so there's your Treasury issuance. We're keeping a close eye to watch this grow. So far, the best news this week is that foreigners are fighting over this T-bill issuance. It's no longer being picked up by the Fed, and it's no longer being put completely on JP Morgan's books. So we are seeing the big players, the central banks, fighting over short-term US debt products. Now, is this some sort of hidden deal because we're giving them free ability to exchange their currency for dollars? Or are they predicting that this is the hedge they need to protect their equity books? Probably both. Okay, so that's what's happening in the bond market. So once again, this is a very unusual move. Stocks going up with 30 million unemployed, and negative 5% GDP. People are forecasting negative 10 to 15% GDP next quarter. So really more confident today than ever before on this positioning. So if anybody's worried, I'm not highly confident in this. Tony, I see you have your hand up. Do you want to do a question?
Yeah, on the spreadsheet on the USO, I was noticing that on the summary side, it wasn't updating to the market. I don't know if it's, or at least mine isn't. It's got a
Oh,
bad
it's not
formula.
pulling your price?
Not pulling the price on the summary side. What I did is I adjusted the quantity based on the split and the price based on the split. And then I took the option and I moved it over, instead of having it in the open option side, I moved it to the closed option side and just updated it manually. And that gave me the same P&L as I've had on my toss sheet. But today, the price that it's showing on the USO itself on the metals and commodities portion of the position is not what's accurately showing in the market. I don't know.
Okay, I'll check that after the webinar, and if there's a technical glitch, get that fixed for sure. Thanks for pointing that out. Absolutely.
I just thought I'd bring that up.
Oh yeah, good point. I'll definitely take a look. Okay, very good. So yeah, I'll keep that. I'll get onto that right after the webinar and just take a quick look here too. So let's see what USO is coming in at on. So here's the way I did my accounting on USO. Right here. So Ryan, can we get Tony the replay of the boot camp from yesterday? It has a really good tutorial on how to do your USO accounting, so you don't have to worry about that, Tony. So good question, and I'll check the real-time feed on the price of it as well. But this is an easy way to do your accounting, to account for your in the money put. Okay, great. So let's continue. So, okay, so there's our basic analysis. Growth of debt is bullish for bonds. Central banks and the primary dealers, foreign central banks and local primary dealers are going to have to buy trillions of US debt. And if you think they're going to lose money doing that when they control the money system and the Federal Reserve, then I got news for you. That's not happening. And if you think stocks are going to have better profits and earnings in the next 12 months, then again, I've got news for you. That's also not going to happen. So that's why we don't want to change our positioning just because of a 1 month move that was driven. Now, a good question is, were they doing that to save the credit market? Were they doing that to fund the government short term? And so I'd say both. They wanted to protect the treasury market. This is our most valuable asset. It's how we live this lavish life without the money we need. But it's also how they got the treasury the cash instantly that it needed to begin doing all these paycheck protection programs and a whole lot of other stuff. So this was the mechanism. But now the short-term debts are being picked up by the foreigners, and that's great news. So I would anticipate that this will continue to drop. Okay, so that's really the critical thing to understand is to get the direction of the bond market right first. That's real money. Okay, so the bond market is real money for every dollar in the bond market, whereas the stock market we call funny money because there's not $30 trillion in the entire real world, and it's valued at that level. So if everybody were to sell stocks, very few people could get it out at the current price before there would be no money left in the entire world. So stock market's far riskier than the bond market. Dave has his hand up. Go ahead, please.
There we are. Can you hear me?
Yes, sir.
Oh, how you doing? So I had a question on foreign currencies as it relates to us getting out of this pandemic crisis. So you take a look at Australia and their currency was kind of beat up. Now they seem to be coming out of it. Their currencies currency is rising. How is that going to affect the currency of, our U.S. dollar compared to other countries if they can come out of it and their currency becomes more valuable? Does that have any impact on what we're doing in your positions in the U.S.?
Yeah, so I do track the dollar quite closely. My prediction is dollar will rise in value and other currencies are going to be losing value. So I'll cover that for sure. Good question. In fact, I have a whole chart just on foreign currencies that are important to track, which are these.
Great. Thank you.
Yep. Yeah, great question and critical. So the biggest market is the currency market. After that, the bond market. Jack, go ahead.
Hello, can you hear me?
Yeah, yes, sir.
Yeah, talking about currency, is the currency you say that is going to US dollar is going to be strengthening, but previously you were telling me that because of we are printing so much money, the it's going to be inflation. Do you think you're still thinking that the US dollars is going to be a lot higher than any other currency?
Yes.
Just,
yeah, I'll cover
how
that.
is that? Can you explain?
Sure. Yeah, I'll cover that. Okay. Very good. I'll cover currencies absolutely in every presentation. So certainly we'll cover that. Good questions. Good concern. I know people are looking for what currency they should buy to help protect wealth, and I would say that yeah, you should hang on to your dollars. So I'll cover that. Thanks for that question. Okay, so let's. I do have an order. I want to go through the data, so I'm going to present in a certain order, and I do promise that that will be answered. So thank you, Jack, and I'll cover that in a moment. Okay, so we'll make our way to currencies. I do have a specific order. I want to go through the content. Okay, so first we got to predict what's the government going to do. They're going to grow their deficit at an accelerating pace. And again, the analogy I like to give you is if you're in a train and closed all the windows, we could be traveling at 100 miles per hour. As long as the rated speed stays the same, it'll feel like you're traveling flat. Okay, so if you're in a train, it's going 100 miles per hour, the windows were closed, you wouldn't know you're traveling at all. It would feel like you're staying still. Okay, that's not what we're looking for in predicting the bond market. We really want it to be an acceleration of growth of the debt to be bullish bonds. Okay, so last year, just over $1 trillion deficit that we had to sell in the treasury market. This year, they're planning a little bit of growth of that, about 1.2 to 1.5 was what was being anticipated as our deficit this year, which is a lot, but it's still a relatively flat growth, very little growth of the deficit year over year. That in itself would actually just be very bullish for stocks, okay? But what we have coming up is the exact opposite. In fact, we're probably going to grow the deficit at a rate of over 100% year over year. So that's huge. Now, next year, if we get to, let's say we get to a $2.5 trillion deficit this year, that's about 100 to 125% growth of the deficit year over year. So that would incline me to think the biggest move in the TLT would happen in the coming 12 months as they try to accelerate that growth. Now, the subsequent year, perhaps it's still a growth of deficit, but let's say we only go to a 3 to 4 trillion deficit next year. That would still be a growth of the deficit and at an accelerating pace, but relative to the growth from last year to this year, much less. So I do think in the next 12 months, we could potentially see the biggest move in the TLT. And the subsequent 12 months, it may slow down. And that's again because the growth of the debt is not at the same acceleration as we're about to enter. Now, again, I'm projecting this so far, they haven't sold any of the debt. All they've done is issued some short-term T-bills that they're going to have to roll over on a weekly basis. And only until this week have foreigners started to pick up the tab. So the timeline for how long the bond market's going to rally really is correlated to us growing this deficit and how long it's going to take to offload it to the world. So we got to pay close attention to this. Okay, so when they first had this pandemic, they're saying $8 billion bill, that'll fix this. I was like, no, it's going to be trillions. A month later, we have a $2.6 trillion bill, and they're just getting started. So bond market could be going up for a long time. The only thing that really gets in the way of the bond market is inflation. Okay, but to have inflation, you need full employment. Okay, that's really the bottom line is you need full employment. So until we have full employment, I'm not going to be worrying about inflation wrecking my bond trade. And I'm also not going to be getting too aggressive in the gold position. Okay, so both of those rely on inflation. So that's the single most important thing to understand. Government is blowing out its deficits. That in itself is going to make our plans play out. Timeline, we have to look into the details to predict the timeline. All right, let's close that. We'll skip the bond yield today. Here's your QE that, again, if we go back to 2008, you can see they did a one shot and then they went flat. I do think they're going to go flat here also. That's how they incentivize buying and holding debt while the government tries to plug the holes in the ship. We haven't plugged the holes in the ship. We haven't even sold the debt to plug the holes in the ship with yet. So that is coming. Okay, next chart I do want to look at is federal funds rate. The gray lines represent recessions, stock crashes. What happened in every single recession, stock crash? They saw it coming well before it happened. They cut rates to zero and created the mechanism for banks to profit from bonds and to buy stocks at the bottom. In fact, the banks create the bottom when they get to sell those treasuries for a big profit to their central bank and then turn around and inject all that money into the stock market. So that's why stocks bottom. It's because these big banks are getting a huge payout for financing the government to fix the underlying disease in the economy, whether it's a bad investment in mortgages that were turned into derivatives, whether it was bad investments into .com companies, or whether you had to shut down the entire country for months on end. It's the same game plan. They use it over and over again. The banks make out like bandits. So my suggestion is follow the money, follow JP Morgan, do what they do. They are one of the most successful banks in history, and especially as of lately. Okay, so what's in their books? I'll tell you what's in their books. Bonds, bonds, bonds. Okay, next thing I want to look at is the yield curve. We're only going to go back a few months, but this actually occurred much earlier. When the yield curve inverts, this is your heads up that things are not right. And it causes the Fed to cut interest rates typically. So sure enough, yield curve inverted, and it did this again last year. That's when they first started cutting rates, but they pushed rates to zero. And you can see the T-bills have gone to a extremely low rate. So why would central banks be fighting over interest rates that are about 0.1%? It's because they think these are going negative. Okay, what happened to the product we're playing? It went from 2% yield to 1.65, 1.3, now it's at 1.28. So the trend is the Fed controls the front end and that drags the long end alongside. So my expectations, these will go negative. We'll see this hit 1 and 0.75, then 0.5, and potentially see very negative yields worldwide. So we'll keep a close eye on that. But this is exactly what we want to happen, is to see people loading up, not the Fed, but other banks buying this does tell me good times ahead for the yield curve going lower. Now remember, bonds go up if yields go down. Here's a very popular metric for predicting yields. It's the copper gold ratio. Copper goes up when we're building, and gold goes up when we're printing too much money. So when this ratio points down, typically it's highly predictive of the 10-year treasury yield. And you can see it's aiming straight down right now. So there's no building, lots of money printing, and low rates. Okay, so gold copper ratio is also telling us the same picture. Big picture in the stock market, we're going to go back to 1980s. Japan was taking over the world. They let their manufacturing sector just take off, but the government took advantage of it, issued tons of debt. Real estate prices went up, labor went up. Companies bailed on Japan as a manufacturing center. Their stock market crashed and it didn't rebound for decades to come. Okay, so they were saying Japan's going to be better than the US, bigger GDP. Tokyo's worth more than California. Okay, didn't happen. Come into the next crisis, and now the purple line's the euro, black again is the Dow. So combining all the countries in Europe and creating that new currency is going to be more powerful than the US with all the might. And so it did outperform by over 100 and at the peak by about 70% extra return on the European index. That was short-lived and took decades to recover. The 08 bubble, you would have thought was all about US stocks, but if you were looking at China or emerging markets, they were just massively, massively growing their empire, building cities for manufacturing and massively building real estate. They overbuilt massively, massively, way too much construction. Half of it got ditched. And so they've never survived, really thrived after that point and are still in a predicament. So they actually outperformed by a factor of several 100%. What happened after that? They crashed and never returned. And the recent bubble, what's the most overvalued? You got it. The US stock market is by far the most overvalued and quite likely has the most pain coming ahead. So that's your big picture stock market. Okay, so now we're going to be looking at gold miners relative to emerging markets, highly correlated. They do well with the weak dollar. And so it's interesting to see how correlated these two are. And again, if emerging markets is showing weakness, the dollar is going to strengthen. So if the dollar is strong, then we don't want to be long stocks in general. And so we'll look at the strength of the dollar in a minute. And what on earth would create a strong dollar when things are in this state where we're printing $2.5 trillion in just under 2 months. Okay, but also I do want to point out that when stocks go down, gold miners go down, as do gold and cryptocurrencies and anything else that is inflationary. So if you're betting big on gold or crypto right now, I would not do it. You can't have a lot of inflationary pressure with 30 million people unemployed and a huge percentage of businesses quite likely to go bankrupt. Here's the best leading indicator I think you can have, Ethereum and the QQQ correlation. These two go up and down together. The same people who are pumping up stocks and dumping stocks have a correlated systematic strategy to sell everything. So we're getting a great heads up when there's trouble ahead in cryptocurrencies. So look, before the stock crash, as of recently, Ethereum was tanking, losing massive value well before US equities peaked out. And on the same note, it bottomed out and rebounded way before US equities. So keep a close eye on Ethereum or Bitcoin. If you see that dropping 10, 20, 30% in a short period of time, you probably have a big player making a move. So that's something we're keeping a close eye on and why I wouldn't be buying the rally right now. Okay, we did the bond stock comparison. Here we have a different look at the yield curve on a linear basis. So 30-year treasury in black, 10-year in purple, and the 2-year in turquoise or cyan. What's important here is the lower this blue line goes, the lower the black line can go. So that's critical that these spreads don't get too tight, as that could signify that there's a bounce ahead. So right now there's a huge spread, and that does tell me that this black line can go much lower, which is great for the TLT. To get to 180 on the TLT, we need to hit the 1% yield from 1.3. Okay, the last big crisis drove this huge move here from December of last year all the way to this level here. So that was a huge, huge move. And I think we can see something similar in the coming months. Okay, we also have to compete with other countries to borrow money. So we have China in cyan, we have the US here, and then we have Japan and Germany, who have been infamously in negative territory. So you have to actually pay money to lend their governments cash. You do that because you think that they will be in a predicament where they let rates go lower and their central bank buys those bonds from you for a profit. So you're essentially paying the government for the hope that they have economic turmoil and allows you to make a profit loaning them money. So as long as there's a spread between the German yield, the Japanese yield, and the US yield, this can go significantly lower. I've been interested in shorting the Chinese bond market, which is still sitting pretty at this 3.3 yield. So that has a huge potential move. And you can see it's been somewhat correlated to our treasury. Now, China's bragging about their economy is perfectly fine, and they dealt with this while the US is struggling. Although I don't think that's true, and add some geopolitical tensions, and this yield could dive lower. So that's potentially a boot camp trade there. FXI, if we get a crash, but we don't actually outlaw the ETF, I could see us going to the February lows. If we do literally outlaw capital flows to China, this could go to 0. So we have that put. Regardless, we're at the 31 strike. So we want it to go below the strike, go into the money, and then sell that for a profit if we think that the government's not going to delist the ETF. If we think they're going to delist it, our best bet is to just hold that position. Now, I think that it would be unlikely to do that ahead of the election, that might be a next year thing, but I still think we have a big crash coming. So look for potentially adding one more FXI put next Friday alongside our SPY put with more duration. So we can sell one into the election for potentially a massive profit and then hold another past the election, hoping that we actually do literally delist it. This is the ETF I'm looking at to play the Chinese bond market. C-bond, haven't had time to research it, just bringing that to everyone's attention. Okay, let's go to the next set of data. Okay, so historic inflation, deflation. This is arguably just as important as predicting government spending to predict markets. A few periods of time I want to point out. So stock market likes low inflation between 1% and 3%. And the more debt we accumulate, the more sensitive it becomes to high levels of inflation. What it doesn't like is deflation or hyperinflation. My expectation is we're entering a period similar to this era where there was deflation, not inflation. So that's bad for stocks, gold, digital currencies, things of that nature. And so that's represented in negative. So if you thought, for example, that people who had leveraged into the real estate market and overextended themselves are not going to be able to make their mortgage payments, are going to default in the next 12 months, and there's going to be forced selling in a global arena in the real estate market. Are you going to buy a house today, or are you going to wait 6 months and see what happens? You're probably going to wait 6 months, right? See if you can get it for a third the price, maybe half. Okay, so that's the big problem with deflation is people start saving with anticipation that their money will be worth more in the future. Okay, so that's what I think is coming down the pipeline. If you lose your job, and if the relative price of goods is going up because labor costs are going up because everybody's scared to work, you get a problem, a big problem. And again, I do believe that will create deflation. So companies make less People don't want to spend horrific for stocks. But what if we do a period of deflation that rolls straight into a period of hyperinflation? Best period to point out that is in the hyperinflation realm, go to 1965 to 1980. So you can see a lot of parallels. Will there be this big 30-year gap between deflation and inflation? Or could it happen right away? Or are we going to have some healthy inflation for a few years afterwards? We'll see. But certainly when every country around the world's massively printing money, the governments are massively growing their deficits, it's only a matter of time before you would anticipate prices rising and people getting back to work to create these inflationary pressures. That's a whole different problem and creates a negative return for stocks and bonds. So with deflation, we want to be long bonds and short stocks. If it's a healthy world with low debt growth and low inflation, we want to be short bonds and long stocks. But if you get hyperinflation, then the Fed's going to hike interest rates, weaponize the dollar, which I do think will happen. And that makes you want to short stocks and bonds. Okay, so that's really one of the worst times to be around was that 1965, 1980. You had a very difficult trading period where, again, if you had bought at 1965, you actually didn't get back to break even in equity markets till 1990. And you hit a bottom in 1980. So very tough times. Paul Volcker was your your chairman of the Federal Reserve that period. And then after that, we had Alan Greenspan and all the doves come in and really just print. Also, keep in mind, what sort of companies are going to have if you keep interest rates low? Well, it's going to be companies that don't care about profits. So think of Netflix, for example. They're not making money, but they sure are racking up a lot of debt and getting a lot of subscribers. They're rewarded to create these deflationary pressures in the market by expanding debt, not by creating profit. If you have high interest rates and a high cost of money, people are only going to borrow if they think they're going to derive a profit. So you tell me, what's a healthier state for the economy? Okay, so now we're looking at USO. Here's the reason we bought USO. So USO is playing future contracts. We want this to go from contango into backwardation, if you guys know those terms. This is highly unusual. So right now, the front month for WTI is trading at 19, where the next month is trading at 24. So there's a spread of about $5 in 1 month from the next on WTI. Okay, that's highly unusual to have such a spread, and very rarely happens in history, as we can see. So what we want for our portfolio is for the red line to cross over the black line. And that means the short-term value of oil gets above the longer-term outlook. So what could cause that? Well, we need a supply shock. That would mean production slows down. We need a storage capacity surprise. So we have the Treasury talking about creating infrastructure to hold a couple $100 billion of oil. Okay, so you keep prices of oil low for too long, people stop producing it because they're losing money, right? So bankruptcies. So we're actually not betting on oil companies. We're betting on this relationship not lasting for long. So my expectation is, again, the supply side has a shock because people go bankrupt or are paid to stop producing by the government. And at the same time, the storage capacity, which is causing this chaos, is suddenly increased, which they're talking about adding capacity to essentially store a couple 100 billion barrels. Throw a little cherry on top, let's buy a couple 100 billion barrels of oil. That'll make the short-term price spike. Okay, so you do all that, USO can sky high, and our target is potentially in the $60 range is where I think we can look for a quick out on USO and then remain long the puts, because the big picture is they can fix the problem for a little while, But in general, until the economy is back to full pace, there's going to be downward pressure on oil. Now that's a smaller market. Bigger markets here in Brent. And again, I just want to point out oil's highly correlated to stock returns. So see that crash in oil correlated with stock crash. Healthy stock market, healthy rise in oil prices. Stocks crash, oil crashes. Okay, so those are highly correlated. Now this one's comparing it to the TLT. Again, the exact opposite. Oil crashes, TLT goes up. Oil crashes, TLT goes up. Okay, now we're looking at gold. So we're seeing some weakness in gold. I do believe this is going to be punished. And who controls gold? Mainly the central banks do. So can they easily sell gold? Yeah, of course. So that's another leading indicator, just like Ethereum or anything else of that nature. Now, how is gold done against the stock market? Well, and is it really a risk-off trade? Well, let's look. So 2008, stock market crashed for a little bit. We had a short bounce, right? But what happens? Stocks continue to crash, gold crashed with it. So did it provide some value and store of wealth? Sure, absolutely. But did it absolutely go up over this period of time? No. Okay, now think about it also. If you're a government and you're partnered with big banks, and of course, many of the people controlling the government come from the big banks. Answer me this, does investors buying gold help us solve the current crisis we're in? No, not really, does it? We really need to fund the government and keep the stock market alive for the private sector. So that's where they have to focus capital flows. So it's quite unlikely that gold will remain at this elevated price if my predictions in the stock market turn out. Okay, so what about gold compared to gold miners and spot silver? And why are we buying gold miners if we think they're going to crash? Well, first of all, if the central banks don't stop printing money, I do think stocks will keep going up despite all the terrible economic news. The government won't be funded, so it could turn around on itself quite quickly. But in this chart, we're seeing that gold miners are also correlated to stocks as well as spot gold. So we're potentially buying gold in this part of the 2008 crash, buying the put so that in a year's time, we'll be at the year hold time on GDX and we can start pulling profits off, because at that point, I want to rotate into spot silver. So the 1-2 punch is gold miners should give us a heads up when we're nearing a bottom in a stock market crash. And it did bottom before the S&P 500 did. Gold miners should outperform most stocks, at least general indexes over that period, although I love the healthcare, biotech companies in tandem with their gold miners. But after there's been a significant rally in gold miners, at some point we want to rotate into spot silver, which is the gold silver ratios nearly at an all-time high right now. And so this is a huge return that every investor who's a precious metal investor is well aware of. But again, we need to see a stock crash, a return to a healthy economy, inflationary pressures, gold rallies for a good year or two, and then we start building into that silver position. That's the same timeline I see playing out. Dollar index is critical. If the dollar's strong, it tells you emerging markets are weak. So people around the world have a lot of debt issued in dollars. So they have to have dollars to pay their interest. They have to buy most commodities and energy products to operate their economy in dollars. Most of the world just straight out operates in dollars. So if there's a shortage of dollars, we see it by the dollar index rising. So if I thought we had a healthy period of time ahead, I'd like to see the dollar index well below 98. If it's above 98, and especially above 100, that tells you that foreign countries are selling their currency because they lack dollars. Okay, so if the value of the dollar gets too high, they really have three options. They can convert their currency into dollars, which weakens their own currency, so it's not their favorite choice, but of course they can print their own currency, so it's free. Their other choice is to either sell bonds or to sell US equities, which would give them dollars. So what do you think you would sell? Well, if I was a foreign country and I'd seen that most companies are going to have bad earnings for the foreseeable future, I'd probably sell my stocks and hang on to my bonds if I knew anything about economics. So a strong dollar, something we closely watch for predictions and stock returns. Strong dollar is bad for markets. So with $2.5 trillion, would we weaken the dollar to go below that 98 level? Not even close. So I do expect the dollar to continue rising. Here's some of the competing currencies, mainly the yen in purple, or rather in green. So that's considered a safe haven currency. We have the Aussie dollar losing much of its value, especially if we go to a longer time range. And the general picture is from 2018 through current. Every single major currency pair has lost value against the dollar, anywhere from 6% to 16% just in the last 2 years. Now that big move up in stocks and the $2.5 trillion of capital, much of which was giving these countries free access to the dollar, gave them a little bit of strength, but I do think that this will continue to weaken. So that's my outlook for currencies. I don't think there's a better currency to buy right now than the dollar, which is why we have a lot of cash for our basic members. Okay, let's see. Now we're going into the final portion of the presentation. Oh, Dean posted they are dropping it from 10 billion to 8 billion, so a 20% drop on the Fed purchases week over week. So that's good news and what we wanted to see. Okay, so now we're going to look at the top data I've highlighted from Twitter. Okay, major US airlines are going to require facial coverings. So just the point of that is just to show that commerce is not going to be what it was. Jerry says, do you think hyperinflation would still happen since the entire globe is printing phony money? No, I don't. I think the money is going to go straight to the bond market because we have a deflation. So yeah, I think the only possible way to have inflation is you have to have full employment. Without full employment, we could go back in time and look at Germany when they went wild and reparations and how they had hyperinflation. But in general, no. Right now, I think that we're not going to have hyperinflation. I think corporations are going to be desperate to sell what they can at the price they can because consumers are going to be saving and not spending. So yeah, there's definitely some nuances to the hyperinflation story, especially if you look at the crazy story in between World War I and World War II, what they did with their currencies, changing currencies, trying to make everybody happy with reparations to the point it bankrupted the whole world. And are we going to go punish China to the point that it puts the entire world into a depression? That's another thing to be concerned about for sure. Okay, so Elon Musk says he thinks his stock price is too high. What the heck is that about? Amazon shares tumble, perjury probe. I'm not sure what that's about. They did put in their earnings call that they have to put something like $3 or $4 billion aside for the pandemic causing their business not to operate. We've got people getting sick, so their labor supply is having trouble right now. And that's the same for all companies right now. So even your top dog, who were expecting blowout returns last night, is having trouble. And God only knows how much money I've pumped into Amazon in the last couple of months while abandoning retail local. New York Fed's forecasting negative 9% GDP, so that's good for our positioning. They're talking about this huge world index fund that has something like $60 billion in it, cutting China out. So that would remove $6 billion. They do that, you can guarantee China will retaliate. Luke Groman, alternative title, US considering capital controls vis-a-vis the world's factory and biggest creditor nation. So actually, Japan's a bigger creditor to the US than China currently, although China does have a good trillion of our debt. They are certainly the world's factory. So that's what makes it very difficult to break paths with China. Here is Chinese propaganda showing that, look, we're out having fun. But what are they doing? They're all wearing masks. The whole world's going to be wearing masks for quite some time. We'll look at the vaccine hope soon. Fed Kaplan, US likely to get 20% unemployment rate. So again, that's obviously not good for consumer spending. 70% of our GDP is consumer spending. So, you can put the math together. That's not going to help corporations grow profits. 20 million unemployed, 60,000 dead, collapsing GDP. No problem. Let's buy stocks. China tariffs, ? Sell everything. So yeah, it's been a confusing push up. So why did we have the QE? Well, we had to get a quick $1 trillion to the Treasury so we could bail out everybody. So that's why they had to do that out of sync of when they normally do it. So should I have anticipated that? Yes. Okay, Boris Johnson, I can confirm that we're past the peak. No, you're not. And we are on the downward slope. Oh God, just go look at the 1917, 1918 horror story. They made the exact same mistake, and we're now repeating it today. $6.66 trillion. That's how much the Fed's balance sheet has grown. So they try to do a little quantitative tightening with the red hot stock market, and that almost crashed the whole global economy. And so what did we do? Cut rates to 0 and print a couple $1 trillion, and they're just getting started. Now, again, I do anticipate this will slow down rapidly and flatline so that we can force everyone to buy and hold treasuries. And again, that's what's going to suck the life out of stocks outside of just very poor earnings. The speed at which Hong Kong became a failed state was breathtaking. So he's been the one really educating people on this Hong Kong trade. What's beautiful about Kyle Bass's Hong Kong trade is that the risk to lose money is really very little, 19 cents a day per mini contract. But the opportunity for China to ditch Hong Kong and move its financial center to Shanghai could make the currency absolutely collapse. And if that's the case, we can walk away with a 100-to-1 return, risking not even 1%. We're really risking something like 0.1% per year to hold that position for the opportunity to double our wealth. Okay, you don't get opportunities like that. This peg hasn't budged for 3 decades, so you really need geopolitical chaos for that to arrive. And unfortunately, it does look like geopolitical chaos is in the books for the near future. For national security purposes, it's time we decided to make our own medicines and keep ample supply domestically. So it's kind of like, you don't want to employ your enemy to make your bullets, right? So we're not going to outsource that. So yeah, a lot of manufacturing is going to ditch China, come back. That's going to cost a fortune. And there's some more, you're looking for inflationary pressures over the next decade. Well, let's print $10 trillion and make the cost of labor go from $3.50 an hour in China to build an iPhone and pay an American $15 an hour. Well, you're going to have some inflation there. But again, to have the reason to buy crypto and things of that nature, I'd still want to see not having a 20% unemployment rate. Okay, another Chinese propaganda. The world's top scientists haven't figured out where this came from, but a few U.S. intelligence officials have. They said it's from the wet meat market, but they went and bulldozed it. So you can't go investigate that. The person in charge of the lab was replaced with a military leader, and they're all being silenced. So plus we're not allowed to go investigate what's happened there. So it's quite clear that they knew about this way back in December and lied to the world and did everything they could to make this spread massively. Now, whether they leaked it into their own population on purpose or whether that was an accident or if someone foreign leaked it into China, that I don't know. But what their actions were after it was clearly spreading and well known, that we do have a pretty good chain of evidence that we can make predictions based upon. Why on earth would the federal retirement funds invest in companies that don't adhere to U.S. security laws? Okay, so we have more companies from China being proven to lie about their books. Belt and Road Initiative was essentially a lot of loans to a lot of really poor countries by the Chinese. With this event, most of them are unable to pay their loans. China has been seizing up lots of assets of all these surrounding countries in not just this year, but for the last several years. So they're making these very aggressive loans and taking over lots of assets when these countries can't pay their loans. Trump declines to say whether he holds Xi responsible for misinformation from, of course he does, but he has to be careful. We're not quite ready to decouple yet, and we have an election coming up. So we'll see what he does. That's hard to predict when he's going to accelerate the trade war. Clearly, though, we knew China was never going to do trade phase 2. Phase 2 was essentially change your government structure, take away all of your advantages, and be our little pet for the rest of your life. And China wants to be equal as America for their half of the hemisphere and not bullied by the US. So they have no intentions of changing the government structure, which has a lot of advantages when operated properly to take over certain sectors. So that's the big problem is US has a bunch of little companies. China's took their whole country, turned it into one, essentially one company and laser focused all their efforts in key industries. So that will put us out of business and not able to compete unless we try to copycat their strategy, which again, our government's not structured to do. So big problems there. On a 4% drop in price, Apple's $50 billion buyback goes poof, 25% of their cash on hand. So that's what they announced yesterday when they said they have no guidance. Investors did not like that. Here's that Carl Icahn trade. I'm not quite sure how you do this as a retailer. CMBS index, the triple Bs are what he's been betting against. It's mainly the malls. Huge percentage are delinquent, not paying their rent. People are starting to file bankruptcy. Great for our general strategy. So I don't think we'd necessarily need that more advanced trade, but I have it as a potential one to research. Federal Reserve bought more treasuries in the last 6 weeks than the whole foreign sector bought in the last 6 years. And again, that's because we had to quickly raise $1 trillion to get it into the treasuries coffer and then start issuing it to small businesses, to unemployment. And apparently we needed to send it to a bunch of museums and donors of both sides of the aisle as a urgent manner. So that's why we had to buy so much of our own debt so quickly, but don't be fooled. They will want to roll that debt into longer duration and sling it off to the rest of the world. And they tend to do that at the same time that they create chaos. So a little chaos goes a long way when you're trying to sell bond products. Wells Fargo halts accepting new home equity credit. So all the banks are loading up billions of dollars for loss prevention, assuming that many are going to default on their loans, and they're stopping new loans. So this is absolutely horrific for the real estate market. Okay, so those are the top notes from there. I have a few articles. We've got this Operation Warp Speed. They're trying to get 100 to 200 million vaccines this Christmas. This means they're going to bypass the typical phase 1, phase 2, phase 3, phase 4 protocol that protects society from who knows what can happen in these different vaccines. Sounds like a disaster. Usually it takes 3 to 5 years to develop a good vaccine. When they're saying 18 months, I was skeptical of that. When they say 4 to 5 months, I'm even more skeptical. This sounds like something that straight out of a zombie apocalypse movie. Who are some of the candidates? This Oxford company in the UK is already doing human trials. So I think what they're really saying is that we're going to make this rollout of 100 to 200 million vaccines part of a phase and primarily get it to the front line dealing with this crisis. So we'll keep a close eye on that. between Bill Gates and this advisory board controlling the CDC and these different entities who are also, again, the same people at the top of these ETFs we want to buy are controlling these administrations that are making all these decisions and recommendations. So yeah, those ETFs look very hot once we do get to a point where the market's been repriced. So this is one vaccine that's being tested. What can go wrong with the vaccine? Well, the big problem is you give the person the vaccine, it creates the antibodies, you wait a month or 2 or 3, and then you give them the real disease and you have an autoimmune response that kills you. So yeah, huge problems can happen when you're not careful with proper testing. Also, I want to point out we never solved the SARS virus with the vaccine. They gave it to a mouse, created antibodies, they gave them the virus again, and it killed the mouse. So this could be a horrifyingly bad science experiment that goes wrong, or it could be a miracle. So we'll keep a close eye on that. This could change the timeline to getting things back to normal. So we got to keep a close eye on it. CNN obviously not too happy about this. In this headline, makes big bet with unproven technology. So is this real? I don't think so, but we'll have to keep an open mind to that. This is the, and again, all these links are in your resource document if you do want to do some more research. Here's the fellows that are actively testing this on humans right now. So we'll see how well it works in the coming months. They're anticipating news in about 6 weeks. Here's a summary of different people racing to create vaccines and where they're at in the stage. Moderna seems to have some inside help with Bill Gates beyond Gilead. So those are the two I'm really interested in, outside of Johnson & Johnson, who's also working on some solutions. So keeping a close eye on that. Is there a vaccine in the near future that does change the timeline? I haven't had time to read this. China embassy publishes a 16-point coronavirus rebuttal. It's in German, so that part I couldn't read. Here's your summary. But they're trying to say that we did it, that we brought this over to the Wuhan International Military Games and spread it that way. And this came from Fort Detrick, and it's all US's fault. Okay, so is this a big hoax? I think we can put that to rest by looking at average death data. Average deaths are clearly rising at a rapid pace. So this is dangerous. Lockdowns are warranted. And if we hadn't done one, things would be much worse. Did we do one, anything like China? I'd say no. Isn't going to come roaring right back. I'd say yes, unless they do some pretty crazy schemes to track it, which is in that Scientists Against the Virus PDF 17-page document we gave you guys yesterday. They want to test every child who goes to school 3 times a week, every person who works in a public retail store 3 times a week. If you, when you leave, you'd do a spit test that goes to a lab. Lab will tell you by the next morning if you have it. If you have it, they're going to do contact tracing to your family, to all your people you work with, and then try to put out the fires as they come. I think that would work. It's pretty insane. Would cost a fortune. It also involves everybody wearing masks everywhere. So far, I don't see that being rolled out. So I'd say that quite likely this is going to come ripping back here. Here's New Jersey. Just, here's your last 2 years of average deaths. And again, this spike of deaths is a period where normally deaths are on a decline coming out of winter, not a sharp rise. So again, this is a very dangerous. And the main reasons it's dangerous because we don't have herd immunity. It hasn't been around so long. The flu's been here for a century. So most of us have some level of protection in our immune system. This little monster that's come out is new. It's novel. We've never seen anything like it. It has a lot of very difficult properties to contain it, mainly that it spreads without symptom in the young. The young pass it to the parents, parents pass it to the grandparents. So impossible to stop because it's contagious. It spreads without symptoms in 90% of the people who get it who never know they've had it. So unless you're testing everyone all the time, everyone's at risk, especially people over 65. Okay, this is a more detailed article about the Belt and Road Initiative. All these little countries are going bankrupt, and China's set to take their assets if they can't pay for it. This is an interesting article. We also want to know, do antibodies even matter? Are we going to just get sick again in 6 months? Is this more like HIV, a disease you live with for the rest of your life? Or is it one and done? You get sick once and you'll never have to deal with it ever again, like chicken pox or something of that nature. So we don't know. At first, we thought this was only affecting the lungs. Now it's becoming quite clear that it's also affecting your arteries and your blood cells, causing stroke and heart attack. So it's not just attacking the lungs, it's attacking anywhere there's an ACE2 receptor, which is all over your entire damn body. This article points out Redditors who are in their 30s who've been sick for 2 months now and they're not getting better. This is a small group, obviously, but does lead you to wonder how long are these effects and can you get sick more than once? Coronaviruses, which this is most correlated to, they are finding that people are getting sick with this exact same strain of a virus more than once a year, insinuating that if we did get a vaccine, it may have temporary benefits, not long lasting, and that the antibody tests may not be one which could assume you're no longer a risk to society. Okay, some more data about the chronic infections from China. Careful about anything that comes out of China in terms of reporting it. Exxon reports its first quarterly loss in 32 years. So that just goes to show you the extent of this. Local physician shares antibody results. This was interesting. So she tested her staff and 5% had it, then waited a month and did it again and 20% had it. These are the antibody tests. So similar to this, we just did a big test in the prison group and some huge percentage of the prison population, 70% were coming out positive with the active virus, but they're asymptomatic. A week later, now we're getting people sick in the prisons and starting to pass away. So I do think that the infection rate is very high and that there is a lag before obviously people get sick. Okay, so antibody tests are on the top of my radar. Amazon tumbles after projecting shrinking profits on billions in pandemic costs. We've covered that. That was a company I thought would do well yesterday, and they're giving us reason for concern. Mayday on Mayday, unprecedented strikes planned at Amazon, Walmart. Okay, so as well as people planning not to pay their rent. So this is bad for banks, bad for corporations. CMBS implosion, unprecedented surge in new delinquencies. Okay, so we did cover this. This is Carl Icahn's trade he got into last year, and he is making a fortune on that. And last set of charts, let's see what we got. Okay, so we'll finish up just going through our model and predicting how long is this shutdown going to last. I'm now thinking that we will be lucky to see a bottom in stocks around November, December, based upon essentially speeding up the spread of the virus. So it looks like the economy can't afford to remain shut down, and they're just going to open this up. And so quite likely by this winter, we're going to have to do another lockdown unless there's a miracle vaccine out. So if we go into another lockdown, I might think that the bottom is hitting in 2021 and not in November, December. So that's very important for our models. Okay, again, we are seeing that very unusual spikes in death during a period when deaths are sloping downward. So it's quite clear this is very dangerous, not a hoax. Whether it was planned or not doesn't matter. When we get a vaccine or herd immunity, does. So I would anticipate, again, this start to rise again and case counts to rise. Our modeling is suggesting that we're between probably about 1 to 3% of the total population has had it. And if you go to super hotspots like New York, in the worst areas, you might have 20% of the population's had it. So we're nowhere near herd immunity, not even close. So that is important for timelines. US, again, we're seeing it flatten. People think this is the worst behind us. We're just getting started with our modeling. Okay, Italy, same picture. Spain flatlining, but again, same thing, extreme lockdown to achieve it. If they open back up, we can expect the reverse to happen. Same with Germany. Same with the UK. We have Boris Johnson saying we're past the worst. No, we're not. Japan is having exponential growth. They were the last to lock down. Singapore was a hope for a while. They have hot temperatures, one of the richest healthcare systems in the world, most advanced, and they're growing exponentially, mainly with their migrant labor force. It's spreading like wildfire. Okay, China is now having new cases. Is that propaganda? Probably. South Korea has flatlined it. The most extreme measures seen to date. They really dealt with it, but I'm sure that will be a big blow to their economy. India, Indonesia, Pakistan, Brazil, Nigeria are all having exponential growth of new cases, and they're not going to do anything about it. They're too poor. They can't afford to shut down their economy. So their plan is let it rip through. So unless we do intend to lock out these countries from flight, quite likely they'll spread it around the rest of the world, regardless of what the rest of the world does. So, okay, guys, that is a wrap of what I had for today's presentation. So Dean wants to review our options one more time while I take any last questions, and we'll let you guys go for the weekend.
Nice, Jason, and incredible presentation. I was able to catch the last probably 10 minutes there.
Nice.
Very nice. All right, guys. So just real quick, if you're on a trial, make sure to sign up today. Okay, so you can get your bonus bootcamp content. So that way you can kind of continue to study over the weekend. Okay, watch that module 1 video, learn about your bonus trade that a lot of people have asked about today, and just put you in a place to protect your capital, okay, and massively expand your base to then go in and buy stocks with. And thanks, Jay Wills. Thanks, Michael Seaback. Appreciate you all joining us here. Appreciate your time, guys. And those puts are gonna they're gonna pay. It took a little pain first, but you know, the best things in life take a little time and a little work. So okay, guys. So real quick, Jay, if you want to scroll down just a little bit so we can go over to the boot camp. You know, Jay may have hopped off for a water break. All right, guys. Oh, cool. Thanks, Jason. And yeah, so guys, there's a couple awesome testimonials that you're going to see on there from our member base. I think Scotty might actually be in here. I saw him in here earlier. Hey, Scotty, we have your testimonial up. Would you mind chiming in, saying hello if you have a moment? Okay, looks like Scotty may be away from his computer or doesn't have the ability to speak, so I absolutely understand that. Okay, guys. Hey, Scotty, are you there?
You know, I think Ryan has the control. I'm not sure if Ryan's still there to unmute him.
Okay, got it. Okay, okay, guys, we'll just roll through that. And thanks, Ron. Appreciate your time for joining us. I don't always get the chance to thank you, but thank you for coming for joining us here today. All right, Jay, if we want to just scroll up just a little bit, bud, we'll go over the boot camp first. And Jason, what would you say? What do you think has been the kind of the general client reaction from the people in the boot camp? You know, I know, you know, I hear from clients that it's great, but what do you see? I mean, you're in there more than I am. So just what's the general reaction on the boot camp? What's the general feedback that you get?
I think, so there's really two big things about the boot camp. We have the Tuesday content where I give you the best content to study that I've devoured over the previous week, which you can see is a lot of content. So I take maybe 100 hours worth of studying and tone it down to 5 to 10 hours. So I love that part. I think a lot of people get a lot of value out of that. That's on Tuesday. On Thursday, we do the live webinar, and we have a lot more time to chat. Everybody, I try to encourage to at least say hi and to talk out loud, to ask questions. So we do get a lot more one-on-one. But in general, we're learning how to fish versus just putting the fish on the platter for you. So we're studying how the market works, how to build our spreadsheet, understanding futures, Forex, options. There's a lot to learn, much less American history, world history, Federal Reserve history. So yeah, there's a huge amount of content. And it's not like your typical boot camp where they're gonna put you in there, give you some content you could have got off of YouTube for free for 12 weeks and then send you home with a $20,000 price tag. I've seen that so many times. There's nothing in our course that you'll find online, period, that I've ever seen. So I do think our content's much more unique, much more in depth, and also it's a lifelong membership. So you buy it one time, and you're going to be meeting with me Tuesday with the content, and then Thursday with the live webinar indefinitely. So it never ends. So I would say that's some of the big values of the bootcamp. Plus, we have trades that are speculative. So I don't put out the speculative trades in the basic or pro membership that are high risk in terms of we do need a big catalyst to get a payout. But if that does happen, the profits can be incredible, like the Hong Kong trade, for example.
Nice. Very nice, Jason. And thank you very much. That was a phenomenal summary. All right, guys. So you do have that option to join the bootcamp for life. Okay. Literally get that lifetime access today for less than 10 grand. Okay. A lot of the live in-person bootcamps that are, only 5 days cost 20 grand or more. We've had them with our past company. This is just so much easier, and it's honestly perfect for what's going on in the world right now with the virus. So you can jump into that. Okay. And then we also give you a free year of the pro portfolio that you see right above it for free. Okay. But if you have between, 75,000 up to a couple million, the pro portfolio is beautiful, guys. It's phenomenal. I love the safety, and yeah, we have a little drawdown, right? So I was just looking at things. I think we're down about 4% for the year, but the market's down 21. So that's incredible. And we're smoking Ray Dalio right now with the pro portfolio. So that's kind of cool. And the next, if you have between 30 and 75K, the basic option will work for you. It's just trading options now. So you're gonna get a lot of leverage out of those option trades. All right. And if you're new on the trial and you place the SPY trades today, you've probably taken care of that membership fee at this point. Okay. And then last but not least is the buy and hold portfolio. If you have less than 30K, beautiful option for you. And Jason, with that, I think we're good to go, bud. All right, guys. And if you have any questions, my number is in the top right corner. If you haven't already saved my cell phone, just call me or text me. We'll get you upgraded, and look forward to working with you folks. Thank you very much for your time. Truly appreciate all of your time and attention, guys. Look forward to helping you navigate these wild new waters that have never been seen before and profit from it. And tell you when to get back in and buy the market, but geez, it's going to be a while from now.